with a $3 trillion market cap. They wrote this: generative AI looks to significantly expand the scope of business processes able to be automated by software. Microsoft stands best positioned, they think, to monetize that expansion, which, accompanied with a still reasonable valuation, makes Microsoft their top pick in large cap software. Broader market, as I say, is negative this morning. We're down 1%. Yields are a whole lot higher by 9 basis points at the very front end, just shifting away from session highs. Still north of 5% though on 2s, on 10s north of 4% and up 9 basis points today. Amy Silverman of RBC with this to say: post the holiday, we could see volatility perk up again as we head into earnings season. Amy, I'm pleased to say, joined us now. Amy, can we build on that? Why you expect volatility potentially to pick up?
Sure. Look, we were obviously last week in the midst of the summer doldrums with the July 4th holiday. But, as we head into earnings season, this historically is a time, in particular in the first 2 weeks, where you see volatility buying. And we really have had volatility just absolutely pummeled John. Data like today perhaps changes it a little, but we've just had really suppressed levels and folks keep selling it even further.
It's amazing to have this backdrop. At the same time, maybe we've had narratives all over the place. We've gone from soft landing, no landing, hard landing, back again. And yet, as you've pointed out, volatility's remained pretty low. And the question I know you're grappling with, and you're hearing this question from clients, is whether we should be selling low volatility. How do you think we should express that? Through single names at the index level? What should we do?
Yeah, it's a really interesting question, and it all comes down to the math, because as we all know, it's been very narrow breadth. Even today, you guys were talking about threads earlier in Meta. The first thing that comes to my mind as a derivative strategist is, well, where is Meta the biggest, chunkiest weight? It's actually XLC, the communications spider ETF. And so you see that interplay. So is it better to own volatility in Meta, or is it actually better to own volatility in XLC? Because one is such a huge proportion of the other that you would expect them almost be proxies at this point. And you see that in the market too. So, one thing we've said is, if you're looking to hedge, Apple volatility might actually be a good proxy for S&P volatility, given how much of a weight it has become and how low it is in that particular single stock relative to the index level.
Just to recap the price action right now, down 1% across the board. Pretty much on the S&P, we're down 1%. On the Nasdaq, we're down about 1% plus. Similar move on a Russell on the small caps. Amy, I want to pick up on what's been happening with the bond market and what it hasn't done to the equity market so far year to date. If I told you earlier this year where yields would be, where Fed funds would be, where Fed communications would be, I could give you really precise detail on all of that. Would have it helped you make a move in the equity market, put money in the right places, given what tech's done so far year to date?
It's astonishing. I would have liked to say yes, but I don't know that that's the truth. So, we usually think of the rates market as leading, and, people like to look at rates volatility on a cross-asset basis relative to equity volatility. That ratio just hasn't worked out this year. It's almost been the other way around, and part of it does have to do with that Magnificent Seven really leading the equity market. And this is why, one thing we've been talking about is this could just be a tale of two narratives. I think the market is fixated on the idea of rotation. What if we just get tech continuing a rally because of the AI story, because of stories like threads? We also get an economic breadth widening at the same time. If that happens, that would tell you that we still lean to be more of a market that's bullish than bearish.
Would that be your base case?
Yeah, look, when I think about that question, I always think about how it's positioned in the market right now for options. And I can tell you there's very little demand for hedging. I can tell you, even with volatility at these levels, people are still continuing to sell it. And of course, that can beget something like 2018, where we had a Volmageddon, but can also continue when you look to history. It's not clear that one always leads to a burst of volatility, especially when you have the case of such narrow breadth continuing to drive that positive momentum.
Big moves this morning, that's for sure. Amy, thank you. Amy Silverman there of RBC on the latest moves. As I've said repeatedly, about an hour or so ago, an hour and 10 minutes ago, big economic data print here stateside, an ADP report that many people will tell you they don't care about. And then, of course, all of a sudden they care about it. ADP comes in hot. Jobs look very good. Yields start flying. Equities start dropping. We're down 1% on the S&P. On the Nasdaq, we're down by more than that. On a 2-year, back through 5%. On a 10-year, back through 4%. Not translating into dollar strength in a major way. In fact, some dollar weakness against the euro today at 108.81. Some more economic data coming up just ahead of Friday's payrolls report.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense.
The PMI data up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. Getting some more data, getting some more information about how the economy is performing, how the past effects of monetary policy are affecting economic activity and inflation, and then basically having a meeting by meeting decision about how to adjust policy.
More economic data just moments ago. Let's get you some of that with Mike McKee. Hey, Mike.
Hey, John. Well, we're getting the S&P version of services PMIs, and they come in stronger than anticipated. 54.4 up from 54.1, and the composite at 53.2 is a little bit higher than the 53 that we saw in the preliminary numbers for June. Now we get the ISM services numbers, top of the hour. They're expected to rise a little bit as well. So we'll see if S&P is any kind of precursor to that, but it does suggest there's still some strength on the services side, John.
Mike McKee, it's pretty phenomenal, isn't it? The distinction that you can make between services right now and manufacturing.
Well, Americans spend more money on services, and it's a service economy. So it really matters what's happening there, and the hard part has been deciphering what's happening there because of the jobs picture and the fact that they've had trouble hiring people for many of those jobs, at least until we saw ADP today.
Mike, does one necessarily have to converge to the other? Can this persist?
It can persist. As you know, we don't have a rule on this. We passed goods with services some time ago, and so we'll probably continue to see services be the strength of the economy, although we're spending a lot more money now to try to build up the manufacturing sector in the United States. So we could converge. We could see something like that happen.
Amazing. Mike McKee, thank you. Just another strong data print relative to expectations. We've seen that repeatedly. We've mentioned this repeatedly too, that economic data relative to expectations, that index, the surprise index, the highest since 2021. Strong data early this morning, but I guess good news, bad news. I know you hate that stuff, I do too, but that's the reality in front of us at the moment, at least. We're down 1% on the S&P 500. Some data earlier this week. Weak manufacturing in China, we know that story. Weak services data as well, something to keep an eye on. And with regards to China, keep an eye on this as well. Secretary Yellen touching down in Beijing, preparing to meet with Chinese officials for economic talks as trade tensions continue to simmer. Kelly Lyons back with us with more. Hey, Kelly.
Hey, John, yes, she's officially there, but her first formal engagement won't be until tomorrow, Friday, where she is set to meet with the premier of China, Li Qiang. She'll be meeting with other senior government officials as well over the course of this visit, which does go through July 9th. But as for what tangible may come out of it, the bar does seem to be set pretty low. The Treasury Secretary, of course, has been expressing her desire to make this trip for months now, but really this is just about opening lines of communication. She is likely to raise issues around trade, around debt relief for distressed countries, issues like climate change as well. But it doesn't seem that we're expecting any major breakthroughs or real deliverables coming out of this meeting. This is really just a victory for the administration in that they are talking. This, of course, follows Secretary of State Antony Blinken, who made his own visit to Beijing last month, and Bloomberg reporting today that after Yellen's visit, climate envoy John Kerry is expected to make his own trip to Beijing to address the climate change issue. But the backdrop here is very, very tough, John. Obviously, there has been a bit of a tit for tat when it comes to the fighting around trade and economically sensitive issues. China, just days before Treasury Secretary Yellen arrived, put export curbs on two very strategically important metals, gallium and germanium, where the U.S. is considering imposing restrictions on China's access to cloud computing. Plus, you have the defense concerns as well. Chinese President Xi Jinping was giving a speech earlier today talking to the military forces around Taiwan, asking them to strengthen drills and boost its capacity to win wars. So geopolitically and economically, a very difficult backdrop for the Treasury Secretary as she starts these conversations.
Kelly, what's your take on this? Does this set the stage for a leader summit later this year? What are you hearing about that?
Well, that's a very difficult question because obviously after Secretary of State Blinken's visit last month, there was optimism that it could set the stage for President Biden to meet with his Chinese counterpart potentially at the summit later this fall. Then just very shortly after, you of course had the dictator comment that President Biden made at a donor event, which China reacted very negatively to. So it's just a question of whether or not the Chinese president may be open to meeting with the president in person, but Biden has continually expressed his hope that a meeting will be taking place in the coming months.
Blinken now Yellen, as you indicate, Kerry next, and potentially a leader summit coming up too. Kelly Lyons on the latest there. What to watch over the next couple of days, as we say, as trade tensions simmer, the tit for tat, back and forth between China and the United States continues. For the broader market, if you are just tuning in, welcome to the program. 20 minutes into the session, equities down by 1% on the S&P. On the NASDAQ, down by a little more than 1%. The data decent, way better than expected on the ADP report. Jobless claims doing okay. In about 10 minutes from now, you'll get a read on ISM services and job openings too. That's really important stuff, particularly with where yields are right now going into it, with a 2-year up by 10 or 11 basis points, through 5%, a 10-year through 4%. Let's get you some sector price action. Here's Abby.
Yeah, and that yield story, John, is really influencing the sector composition. Not surprisingly, with the S&P 500 heading to its worst day since the end of May. We're looking at all 11 sectors lower. Now, super interesting. Real estate is the worst sector, down 1.8%. That, of course, is because as yields go higher, those dividends on the real estate stocks look less attractive. Consumer discretionary down quite a bit, with Tesla being down. Energy, utilities, another dividend-sensitive sector. Tech right in the middle of the pack, down about 0.9%. Consumer staples, which is defense, down the least, down 0.4%. Let's dig in a little bit deeper, though, to tech, because Apple is still below that $3 trillion mark. So tech is down about 0.9%. Apple off of its lows, nonetheless, down for a third day in a row. The stocks over the last 2 days, John, down 3.7% thereabouts. the worst since the end of April. Qualcomm and Apple suppliers. So this is all very interesting on that hot ADP report ahead of tomorrow's jobs report.
Monster upside surprise there. Abby, thanks for that. Ahead of payrolls tomorrow, 225 is the estimate. You wonder if that starts to bleed a little bit higher as more estimates come into our Bloomberg survey over the next 24 hours or so. The previous number, of course, 339,000. Payrolls, 225. That's the median estimate in our survey. 170 is the estimate from Citi. Andrew Hollenhorst caught up with us a little bit earlier on. He's looking for a softer jobs report of 170, but ultimately other data, as we can see this morning, not showing much loosening in the labour market. And Citi's Andrew Hollenhorst looking for another hike in July and another hike in September. And based on the minutes we got yesterday from the Federal Reserve and the communication we've had from Chairman Powell and from the New York Fed President John Williams too, it looks like July, later this month, we're going to get another hike from this Federal Reserve. Coming up next, your trading diary, the runway into the weekend and into payrolls tomorrow morning.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Minutes into the session, equities down for a second day by 1% on the S&P. On the Nasdaq right now, down by 1.4%. Some real weakness in the equity market off the back of better economic data, sending yields up and stocks down. About 25 minutes into the session, that's the price action. Let's get to the trading diary. Coming up a little bit later, about 5 minutes from now, JOLTS data, job openings in America, and ISM services information as well. Another read on the service sector just around the corner. President Biden delivers remarks on the economy at 1 p.m. Eastern Time. Look out for that. We round out the week with the U.S. payrolls report tomorrow morning. And looking ahead to next week, another busy slate of Fed speak and inflation data coming up on Wednesday. We kick off earnings season too. JP Morgan results just around the corner. Tomorrow morning, look out for this full coverage of the jobs report right here on this program with BlackRock's Rick Reeder. Looking forward to catching up with him. Victoria Fernandez across Mark joining us alongside PGIM's Michael Collins. And we'll catch up with the U.S. Secretary of Labor, Julie Su. That conversation just around the corner. From New York City, this was the countdown to the open. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. What a day in the bond market. We're going to check in with Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. She's going to join us in studio. We're going to break down what we're seeing on the economic front and what it means for our Federal Reserve. Plus, Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management. He's going to join the program. We'll talk about the sectors he likes in this market after a very, very strong first half of the year. What does he see with the second half? But we're going to kick things off right now this morning with John Tucker and a Bloomberg Business Wire.
All right, let's get right to it. The next key flashpoints is the JOLTS job opening survey and the services ISM data. JOLTS jobs openings, 9.8 million in the U.S. That's coming in just a little lighter than expectations and a decrease from the prior month. Now, the prior month was also revised higher. As for ISM, this is the services index, the biggest part of the U.S. economy. Expansion there, 53.9. That's higher than the previous month, higher than expectations. Again, anything over 50 is expansion. Services, the biggest part of the economy. I'm going to go right to yields, lightening up just a little for the 2-year, 5.08%. That's still an eye popper. 10-year yield, 4.04%. As far as the equity indexes, S&P 500, 51 points lower. That's down 1.1%, 43.95 in the index. The Dow down 376 points. The NASDAQ 100, 209 points lower. That is down 1.4%. Stronger than expected ADP figures. We got that earlier today behind the latest push higher in the yields. Meantime, Andrew Hollenhorst, the chief U.S. economist at Citigroup Global Markets, he does see inflation heading in the right direction.
Yeah, so we have some positive dynamics over the next few weeks, actually, in the inflation data, where you should see used car prices coming down, shelter prices should be slowing. So there are reasons to think we're going to slow into the end of the year.
And far as some of the individual stocks in the move, say hello to Threads from Meta Platforms, Instagram. The most serious threat yet to Elon Musk's Twitter. In its first 7 hours, saw more than 10 million signups. Tesla, China's top automakers, they're pledging to maintain fair competition and avoid a price war. Tesla shares most active. They're down about just over 1%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
Yes, sir. John Tucker, thank you so much. We appreciate it. Jess Minton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Jess, I take a look at some of this eco data we're seeing here today in terms of the ADP number and then the ISM number that John was just reporting, kind of better than expected. Do we take the whole recession call off the table? What are we doing? What are the economists doing, I wonder?
I mean, looking at, especially to your point with the bond market, looking at the 2-year Treasury yield, it's actually at its highest level in 16 years on the back of that ADP data. So it's the highest it's been since June 2007, just above 5%. So if you look at that over to the equity market in the S&P 500, all 11 sectors in the index are lower, led by declines in discretionary. And then you have real estate down more than 2% as well. And then energy obviously getting pressured with U.S. crude prices down close to 1%, still trading around $71 a barrel.
Wait, think about that, June 2007. I remember that time so clearly.
It's a wild chart with the 2-year.
Great financial crisis. All right, let's check in on those markets. Big moves. We'll check in with Abigail Doolittle. She's Bloomberg Markets correspondent, joining us here in our Bloomberg Interactive Broker Studio. Abigail, lots of stuff out there, lots of moving pieces. What are you looking at?
Well, there's a drop in stocks, to put it mildly. The S&P 500 down 1.2%, the Nasdaq 100 down 1.4%, the chip stocks down closer to 2%, and all of it having to do with these yields spiking. It's hard to know which is more interesting. I think both are not so surprising, because if you follow the indicators that we all follow, the RSI and the S&P 500, and as importantly, Apple, just recently coming out of overbought territory. Apple is no longer in that $3 trillion mark. I think something else that I'm really keeping an eye on is ExxonMobil. They basically pre-announced to the downside, and know that both of you know that I've been talking over the last week or two that I think that this upcoming earnings season could be a little bit funky, similar to what happened with General Mills, a little bit of a disappointment with the guide. And I think that we're going to see some downside surprises. We've had some easy cruising for a while for a lot of these companies, and I think that it's just about to get a little bit bumpy. The charts, the technicals have been suggesting that something like this could happen, and now that we have Exxon doing this, plus, on the other hand, the super hot jobs market. So it's a real contrast in some ways.
Yeah, and looking at the S&P 500 trading below 4,400, and you just were talking about the technicals. What stands out to you? Because we always ask you about RSI. You were talking about how that's come off a bit of the highs that we would have seen back in June, but is it still a bit too elevated in that overbought territory?
So the S&P 500, what's interesting to me is, this is very wonky, but it's in what's called an island reversal pattern. So right at this moment, it's confirmed to go back down toward, let's call it 43.40 or so. If it should break below 43.30, and again, this is super technical, you're going to see a quick move down to the 50-day moving average. I think that will be the case simply based on Apple, because Apple's in a very similar pattern. It's the biggest weighting to the S&P 500. And the question is begged here for all of these tech stocks. Apple up 47% on the year coming into today. Meta up more than 100%. NVIDIA up 190%. Was this sort of a rally deserved? And relative to Apple, I'm just taking a quick look right now, because that's really, it's such a great proxy for the market. So its RSI just last week on that $3 trillion mark had been at a 77.6. Now it's at 63. So it's really very quickly investors, that momentum coming undone.
And you were talking about these levels that you're watching for the S&P 500, pretty close to 43.25, which was that intraday high August 16th of last year, which a lot of times, as you know, served as resistance. But now is that really more of kind of that support potential level there?
For the S&P 500?
Right.
Let me pull up the chart quickly and see whether or not I agree with that. I don't think that that will hold, though, based on the last time that I've looked. If you see the S&P 500 go below 43.28, you're going to see a sell-off to the 50-day moving average, if not below.
Right, so it's right below that.
Yeah,
at
that will not act as support.
Right.
I would be shocked if that acted as support. I shouldn't say definitely won't, but I would be very surprised.
All right, Abigail, thank you so much for joining us. Abigail Doolittle, Bloomberg Markets correspondent. All right, we've got a good block of time here, and we're going to need it. Danielle DiMartino Booth joins us here on our Bloomberg Interactive Brokers studio. You know her work, CEO and Chief Strategist at QI Research. Danielle, thanks so much for joining us here. Boy, a lot of economic data coming out over the last several days. I don't know, the economy seems pretty darn strong to me. I'm not sure if the recession talk is off the table. What does our Federal Reserve do, looking at some of the eco data we've seen over the last several days?
Well, you have to bear in mind, I'm of the mind that the Federal Reserve wants a reason to keep raising rates.
Okay.
And we follow one metric at QI Research the most closely, because it's got the least noise in it. So not statistically, not seasonally adjusted, continuing claims.
Okay.
So I'm gonna make this really simple. Last September, there were 0 states in the United States of America that had rising year-over-year continuing claimants. So the number of individuals in 0 states in terms of rising beneficiaries.
Okay.
Last September. 46 states, as of this morning's data, have rising continuing claimants. That's 94% of the population.
Wow. Okay. So what's that tell you?
And it's been gradual, by the way. This is not like from September and a light flipped on in July. It's been a very gradual move. And it tells me that even though the data is not fast moving, that seasonality is really giving a lot of trouble to a lot of these other data sets. And it just tells you that there's been a steady degradation in the U.S. economy viewed through the purest prism of people continuing to claim jobless benefits. Not initial, they're not applying, they're collecting.
What is ADP? I don't know what to do with ADP data.
You know what you do with ADP? I'll tell you what.
Okay.
With ADP, you go, look, we've had about 348,000 last 6 months NFP, non-farm payrolls.
Yep.
ADP's 363 last 6 months. Okay, fine. It's caught up.
Okay.
Moving on. I mean, some of the aberrations in the data are bizarre.
Right.
I mean, leisure and hospitality. Mining. Did we discover copper in America?
Because
that was a huge pop in mining. So, and we've seen the we've seen the Baker rigs, Hughes rig count. I can't speak this morning. Yeah. I've had too much coffee. We've seen rig counts come down.
Okay.
So there's no reason to think that there's a whole bunch of shale formation that's pulling people into the energy patch.
So you think the economy is weaker than some of the headline data is showing?
I think the economy is weaker. If you look on a granular basis.
So wouldn't that give the Fed some reasons to pause, if not?
I don't think the Fed wants to pause.
Okay.
I think the Fed is looking for reasons to keep going.
Okay.
I think if you pay attention to how they will not discuss the balance sheet, we're not talking about quantitative tightening. It's like Voldemort. They won't talk about it. But they can't have quantitative tightening. They can't continue to shrink the balance sheet if a discussion is even entered into about easing where rates are. They have to keep rates high to keep shrinking the balance sheet.
So we're getting all of this labor data ahead of tomorrow's important jobs report. Yep. And it's interesting, I'm looking at EcoGo and the terminal, and it looks like the unemployment rate is actually going to tick down from 3.7% to 3.6% based on analysts that we're polling in the terminal. You look at when it comes to non-farm payrolls, about 225,000. What is your take on what we could see tomorrow, and obviously how that could potentially relate to how U.S. stocks are moving on the back of this type of data that clearly, not even just the stock market, but looking what's happening with the 2-year?
And the 2-year really is where it is all at this point, right? I think, I can't tell you what NFP is going to do tomorrow. I had a friend of mine, Peter Scheer, he's a good friend of Bloomberg's. He made the comment, statistically speaking, what are the odds that 14 months in a row, all the economists miss the estimate? I mean, what are the odds? I mean, the BLS will tell you that 42% of the jobs created in the last 42 months are against a backdrop of the fastest bankruptcy cycle since 2009. So how do we have a birth-death adjustment that adds 42% net of all non-farm payroll jobs? 42% is not a small number over the last 12 months in the aggregate. Assuming that this is all births, when you can pull up BCY Go on the terminal and see the biggest number since 2009.
So when you see the 2-year at a 16-year high, what do you think the bond market is telling us?
It's telling you the Fed's going to keep raising rates, come what may.
So we've got 90% priced in for the next meeting. They go again after that, you think, in September?
I think it really becomes data dependent at that point, unless there's going to be an investigation launched at the Bureau of Labor Statistics, because they're already questioning the inflation data. That's a matter of public knowledge. So, I mean, barring that, you don't get to 46 states with rising continuing claimants without somebody starting to notice that there's a problem in the country.
So what is what is your overall take of this economy, that there is, in fact, more weakness than the headline data would show, but yet they're still going to raise rates?
It's the but yet. Remember, the employee retention credit, they advertise all the time.
Sure, we did that.
It just pumped $28.8 billion into the U.S. economy in the month of June alone. It's been about $20 billion a month now for about 18 months. There's a massive form of COVID fiscal stimulus that continues to make its way into this economy. You see it in international travel. But as Torsten Slog came out in his morning note this morning and said, the U.S. consumer is slowing. I think it pained him to say that. But if you look beyond the recipients of this employee retention credit, kind of the wealthiest, the highest income earners, you're seeing decided signs of slowing in consumption.
So then with this jobs report tomorrow, we have CPI on July 12th, so next week. And then we'll have the Fed meeting on July 25th and 26th. So those are the last major data points before that. Is that enough for them to decide to potentially hike?
Oh, I think it is. I really do. Again, he's focused on an inflation metric of his own design, the core CPI net of shelter. And it is a slow-moving animal. We've gone back and looked at it historically prior to the pandemic. It was usually running at about 2 to 3%. But 2% was a rarity in that isolated metric that Jay Powell has conceived out of thin air. So in that he's looking at that, I think that it's very conceivable. Omer Sharif is saying, look for used cars prices to come down. Look for shelter to continue falling. Look for that next CPI print to be very bond market friendly, unless Jay Powell's just going to look through it as you go 48 hours into blackout.
Right.
Before the next FOMC.
What is one of the many reasons we like speaking to you is you rip out some data points that, quite frankly, I've never heard of. What are some of the data points that you and your team are kind of looking at here to get a sense that maybe aren't on EcoGo?
So we actually follow weekly data from Lightcast. They started tracking the data as of January 2020 to get a benchmark for which types of job openings there are in the nation. So jobs with minimal education required, they needed a new scale in order to track how many job openings there were for leisure, hospitality, busboys, you name it. That's recently, through the week of June 24th, come down to 0. So there are effectively no job openings using a benchmark of January of 2020. I follow Truflation very closely, TRUflation. We actually were able to get their full data set back to 2012. We ran a correlation analysis with the headline CPI last Friday, 97% since 2012, the correlation. Where's Truflation today? 2.2%. It's 30 million real-time prices. It's a daily inflation print, but a 97% correlation since 2012 with headline CPI tells you exactly where inflation is headed.
So inflation's headed lower.
Much lower.
And isn't that good news for Jay Powell? That's what he wants to see, right?
It's not good news for that Jay Powell. That Jay Powell wants to continue shrinking that balance sheet.
Oh, man.
And he wants a reason to continue shrinking that balance sheet. So he's going to focus on job openings remaining high, even though work out of the Dallas Fed shows that 90% of those job openings are written for the specific purpose of poaching your closest competitors' employees so you don't have to spend the money training them. The other 10% actually reflect organic demand in the economy for new job openings. That's being reflected in Indeed.com as well. You're seeing Indeed.com job postings have come down tremendously over the last 12 months. That's another big one that we follow. And again, it's a weekly data set, and they're speaking to thousands and thousands of companies across the country. That's what you want. You want people who are speaking to people on the ground.
And so even though we see the Fed's preferred gauge, PCE, moving in the right direction, to you, that's still not enough when you're looking at what's happening with the strength on the labor side.
And I'm going to quote Powell here, until the job is done. Until we get to 2%.
And 2%, what is the 2% number? That is the core X.
He's looking for core PCE to be 2%. That is typically the gauge that you're talking about internally.
Okay, all right. And we're not there yet.
Oh.
No, we got some room to go.
Nowhere near.
Excluding food and energy.
But he's going to keep shrinking.
They also
that
like to
balance.
exclude housing.
We get data out today at just after 4 o'clock. You're going to see a big chunk of quantitative tightening when that data hits late after the bell today.
All right. Danielle DiMartino Booth, thank you so much for joining us here. Danielle DiMartino Booth, she is the CEO, and she is the chief strategist at QI Research. She's also did a stint at the Dallas Federal Reserve, so you know about the Dallas Federal Reserve and how the central bankers think across the board. So we always appreciate getting some of Danielle's thoughts here. And again, looking at the market, S&P off 1.2%, NASDAQ off 1.4%. But we're going to bring you to the yield market. 2-year Treasury of 12 basis points, I'm going to round up to 5.07% on your 2-year. That's not too bad to park your money for a couple of years.
Highest level since June 2007.
Yeah, that gets your attention. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, we're keeping an eye on Eli Lilly shares today after it became the world's biggest healthcare company by market value yesterday, surging ahead of health insurance giant United Health Group. Bloomberg's Charlie Pellet reports.
Steve Lilly's climb has been fueled by its pipeline of drugs to treat obesity, along with an experimental treatment for Alzheimer's disease. The rally has made Lilly the top-performing stock in the S&P 500 Pharmaceuticals Index so far this year, and marks the first time the drug maker has closed above United Health in market value in more than a decade. Steve?
Thanks, Charlie. Shares of Eli Lilly currently down less than 0.25%. Meta Platforms stock opened higher, then quickly turned red, but is now up again as the company rolls out its new Instagram app Threads. CEO Mark Zuckerberg took a jab at rival Elon Musk on the Twitter owner's home turf. Zuckerberg tweeted a photo of 2 identical Spider-Men facing off. Musk replied by calling Instagram fake. The rewards for brand loyalty seem to be a little less rewarding these days. Some companies are rolling back reward programs. Experts say the costs of maintaining those programs and inflation are among the factors. For example, Dunkin' no longer gives customers a free drink on their birthday. And if you're a fan of Sephora, well, last month they started requiring a $25 minimum purchase for online gifts for online shopping in order to claim a free gift. And Starbucks has done quite a few changes with their birthdays. First, it was 30 days eligibility, then 1 week, now just 1 day. And those are the company stories we're filing this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets right after this.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. What a morning for data. More evidence the economy keeps humming along here in the United States. The service sector expanding in June at the fastest pace in 4 months. And of course, remember, services, that is the biggest part of the U.S. economy. And then you have the swaps contracts almost fully pricing in right now a quarter-point Fed rate increase by their July 26 meeting. Some likelihood of an additional hike by year-end also being priced in. Then you had the JOLTS survey. This is job openings coming in ever so slightly below expectations. Still solid, though. Treasury yields, they soared as a result of all the data we got this morning, with the idea that the Fed's job isn't over. Stocks are lower. Some of the individual shares that are on the move. ExxonMobil falling after forecasting a $4 billion hit to earnings. And then, of course, you have Meta Platforms rising after Instagram officially launching their app to rival Twitter. S&P 500, 56 points lower. That's down 1.2%, 4390 on the index. The Dow Jones Industrial Average down 445 points. The NASDAQ 100, 213 points lower. That's down 1.4%. Two-year yield, 5.06%. The 10-year, 4.05%. We check the markets for you all day long, right here on Bloomberg Radio. Is Paul already, what is it, threading?
I'm threading. Darn right I am.
Good Lord.
Are you
dating? I'm cutting edge.
The last place I should be is on social media. For any
I think it would be wonderful.
Any number of reasons.
We should start a campaign to get you on social media.
Go social, John.
I just don't fit the criteria.
I would follow you.
That's what I'm afraid of.
Great. Now we get it. Thank you, JT. We appreciate it. And before we get to our next guest, Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management, just looking at the S&P 500, Paul, still all 11 sectors in the index lower. And we were just talking about these huge moves we've seen in the bond market, especially with the two-year Treasury yield. Michael, thank you for joining us. Before we get more into what you're going to talk about as far as what you like about sectors in the S&P 500, I have to get your take as far as these massive moves in the bond market, especially with the two-year Treasury trading around its highest level in about 16 years.
Well, I have to confess that I actually see the current level of the 2-year as being remarkably attractive, but I have been wrong in thinking that for a while now. So, my general belief is that the economy is slowing. The inflation problem is we're seeing in the ISM services today is largely one that's in the rearview mirror. And the risk that we're actually creating through interest rate policy is that the higher level of interest rates themselves are actually now the key risk. This is exactly what we saw with the banking system earlier in the year. I think it's working its way through the corporate sector where we're seeing a dramatic rise in bankruptcies. The odd thing for me is simply that it's not reflected in spreads. It doesn't seem to be reflected in any way in the Federal Reserve's calculations. And candidly, when we look at the jobs data today, certainly coming from the ADP, I have to confess that I'm caught off sides in terms of that strength. I cannot reconcile the data. If I look at the numbers for 2023 on a non-seasonally adjusted basis and compare them to the data from 2022, they're lower in every category. So oddly, we have this seasonal adjustment factor that again is raising its head and just making me really question whether the data that we're receiving is accurate.
So, I guess let's look at it, the economy from a different way. Earnings, corporate earnings. I'm looking at the the earnings for the S&P 500 consensus of analysts, about $222 per share for this year. How much risk, if any, do you see in that earnings number for corporate America?
Well, I think that there's a remarkable disconnect between the expectations data and the actual data that we're experiencing in the GAAP form, right? So the generally accepted accounting principles earnings for the S&P are down to 179. That's off of a level of about 209 from last year, and it shows no dynamic that would suggest that the rebound that analysts are forecasting is in play. Much of what I would argue we're seeing is basically an attempt to ignore the one-time costs associated with either unemployment or layoffs. And in many ways, again, it just feels like the data is being created to match a narrative of rising prices or the reality of rising prices in stock markets versus what we're actually seeing empirically in the economy.
Michael, the S&P 500 is trading around its lowest level in about a week. Something I was curious about when we're looking at some of this stronger than expected labor data, is this potentially a reason for certain stock investors to sell after what was a very strong first half?
Well, I think that there is very much a focus correctly on what the Fed is going to do. And so we're clearly seeing, as you led into the discussion here, indications that interest rates are moving higher, that Lori Logan came out today and said she expects additional interest rates going forward. I think broadly speaking that is really what's powering the market as of this immediate sell-off as compared to taking gains or anything else. We've seen a fairly significant amount of disconnect between the S&P 500, which is obviously market cap weighted and dominated by the large market cap names, and what we've seen in, say, the Russell 2000, which is not up nearly as much on a year-to-date basis. And in fact, the equal weighted Russell 2000 is barely up for the year. So this has been an environment in which the vast majority of stocks have been relatively weak, even as a few mega cap names, Apple, Microsoft, Nvidia, et cetera, have been very strong. In my view, that would represent mostly a flow story, effectively money going into the AI and technology space, driving performance as compared to any indication of real economics at play.
Mike, I'm sensing a distinct tone of cautiousness in your view of the markets and the economy. How are you allocating your portfolio these days? Stocks, bonds, what sectors, that type of thing?
Yeah, no, as I indicated, I absolutely have been caught in the wrong positioning on this last move. I genuinely look at the 2-year bond at 5+ right now and say I can't believe that we're being given this opportunity in an environment in which it seems very clear that at least the economy has slowed dramatically. Whether it continues to slow is really the question. And I see few opportunities for continued growth and expansion. Today's ADP is obviously a wrinkle in that, but again, I just think the data that we received from ADP today was wrong. Can't fully explain it, but that's what it appears to be, where the non-seasonally adjusted data is showing a significant divergence from the seasonally adjusted data. That's true for the claims data, that's true for the unemployment data, that's true for the ADP data.
Something that struck me just looking at the industries within the S&P 500, more of those cyclically related corners of the market are leading declines when you're looking at energy, also materials, technology down a little bit under 1%, also the NASDAQ 100 down more than 1%. But when you think about the correlation between bonds and what's happening when it comes to technology stocks in particular or growth shares, would you expect them to be more pressured given what we're seeing in the bond market?
So I'm not a huge believer in this idea that growth stocks or large cap growth stocks in particular have a quote unquote high duration. In other words, a high degree of sensitivity to interest rates. I think we've obviously seen that, with the strength in the Apples and the Microsofts on a year-to-date basis, where despite the fact that we have much higher interest rates, they continue to push higher. If anything, I think that there's an explanation that has much more to do with kind of portfolio allocation dynamics than any sort of fundamentals around interest rates and valuation. Again, I would just lean towards the direction that what we're worried about at this point is the Fed continuing to be overly aggressive with the hikes that are already in the system, not in any way reflected in the underlying data that we're receiving yet. As that moves forward, if the Fed continues to hike or pauses in its response, that creates conditions under which a slowdown could actually end up being much more severe than is currently being priced in or versus expectation. And that unfortunately continues to be my rising base case, because the Fed is simply behind the curve in the opposite direction. Again, the ISM prices paid data would suggest that the inflation story is well behind us. We see this in Europe, where the CPI, the producer price index, has turned negative. We're just seeing data that suggests that the inflation story is no longer the operative dynamic. Doesn't necessarily mean that that's right, though.
All right, so real quick there, Mike, what do you think we're going to hear from our Federal Reserve at the next meeting and maybe even the meeting after that?
Well, I think it's hard to argue with the market, right? So when the market suggests that they are more than 85% probability of going, and historically it's been about 70%, it's been very rare for the Fed not to take advantage of that. I would expect that they'll ultimately hike and that they'll indicate, as the data suggests certainly today, that the economy continues to represent strength. I don't really think that they're focused on the inflation story as much as they are focused on, or the direction of inflation story, which is clearly downwards, as much as they are focused on this idea of we've got to get back to 2%.
Right.
That is going to be the real question is, do they continue to hike until we get to 2%, which
Right.
is just that they're going to be way behind the curve in the opposite direction.
All right, Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management. Thank you so much for joining us and getting your purview here on how you're positioning in this stock market as well. And Paul, just looking again at these groups in the S&P 500, all 11 sectors still lower in the S&P 500 right now, led by declines in energy as well as materials. We talked about oil prices still trading a little above $70 a barrel, but still down about 1% right now. And then also consumer staples is just down about 0.8% here.
Right. So, cyclical names here on higher rates. Right now, let's head down to Washington, D.C. World and National News with
Paul, Yevgeny Prigozhin is back in Russia. That's what the president of Belarus, Alexander Lukashenko, is saying nearly 2 weeks after the Wagner Group leader agreed to turn his mercenaries away from their march on Moscow to go to Belarus and avoid charges. Lukashenko says Prigozhin has been to Vladimir Putin's hometown of St. Petersburg, may have gone to Moscow as well. The Kremlin says it's not tracking Prigozhin's movements and doesn't want to. In Ukraine today, Russia fired cruise missiles on the western city of Lviv, killing at least 4 people in an apartment building. Ukrainian President Volodymyr Zelensky is promising a strong response. He is pushing for even more support from allies.
F-16s or any other equipment that we do need will give us an opportunity to move faster, he said, to save more lives, to stand our ground for a longer time.
President Zelensky spoke with ABC's Martha Raddatz in Kiev before the attack. Today, Zelensky is in Bulgaria for a one-day visit, and he plans to meet with Turkish President Recep Tayyip Erdogan tomorrow ahead of next week's NATO Leaders Summit in Lithuania. Treasury Secretary Janet Yellen is in China for the start of her 4-day visit. She's meeting tomorrow with Premier Li Qiang, along with her former counterpart Liu He. Jeanette Lowe, Director of Policy Research at Strategas Security, says Yellen will be looking to reset the dialogue.
She's trying to kind of tone down the rhetoric that we have seen over the past couple of months. We've had some issues with, planes coming close to each other, ships coming close to each other in the South China Sea. Jeanette
Lowe at Strategas spoke on Bloomberg Surveillance. Anti-government protests in Israel are turning more heated, this time over the firing of Tel Aviv's police chief. Thousands blocked highways and set bonfires before police and water cannons broke them up. More than a dozen protesters were taken to the hospital. It's a step up from the mostly peaceful rallies back in the spring over plans to weaken Israel's judiciary. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when we have bond yields soaring and stocks are falling. Treasury yields, they're marching higher right now with the 2-year up 14 basis points at round this up to 5.10%. Stocks are selling off again. Every major industry group in the S&P 500 lower right now. Traders are also pricing in on almost near certainty the Fed's going to hike rates this month. This comes after the data we saw this morning showing the jobs market still hot. The data show the biggest part of the economy is expanding. But also, if you look a little deeper into that, a prices paid component there shows some moderation. Meantime, Emily Rowland at JH Investment says investors should remain in equities.
The economic data have come in a lot better than expected in many cases. So you also want to think about this kind of almost pivot party that's going on right now as investors celebrate the idea that the Fed is getting to the end of its tightening cycle. We've only got one more rate hike priced in, then a hold, then cuts.
Morgan Stanley analysts see artificial intelligence fueling Microsoft to a $3 trillion market cap. Microsoft, Meta Platforms among the best performing stocks right now in the S&P 500. Microsoft up 0.4%, and Meta Platforms is up over 1%. As for the major indexes right now, the S&P 500, 58 points lower. That's a decline of 1.3%. We're at 4388 on the index. The Dow Jones Industrial Average, 495 points lower. And the NASDAQ 100, 187 points lower. That is a decline of 1.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Why are you laughing?
No, just killing it out there. I mean, there's a big movement out there in the market, so we appreciate getting those business flashes because there's a lot of moving pieces. So, John Tucker, thanks for that. Let's get right to our next guest, Mona Mahajan, Senior Investment Strategist at Edward Jones. Mona, crazy day in the markets here. I'd love to get your sense of kind of what the economic data is telling you, and what do you think it's telling the Federal Reserve?
Yeah, great points there. And look, I think there was some really market-moving data this morning that we think highlighted a few trends. First of all, the services part of the economy continues to remain remarkably resilient. We saw that not only with the ADP jobs report, where we were up 497,000 jobs when we expected just 225,000, but really what drove that was the services sectors, including areas like leisure and hospitality. We also got the ISM services data this morning, which continued to show an upward trend rather than what many had expected to be a little bit more moderation. Now, on the positive side, both the ADP and the ISM services data did show some cooling in inflation. ADP data, wage gains came in at 6.4%, still elevated, but following a trend lower over the last several months. And similarly, the ISM prices paid component came in below expectations. And so hopefully the message is that, yes, the economy has remained resilient, but the inflation data continues to show signs of moderation. Now, of course, from a Fed perspective, I think this gives them another green light to move forward in July, at least. And we heard a little bit of dissent and debate when we got the minutes yesterday. I think this certainly kind of adds to the case that they could do one, perhaps two more rate hikes ahead. But they are closer to a pause than they have been in recent history. Now, I think the other big part of the markets today, of course, has been what's happening with yields. And the upward move in yields, close to now highs for the year, does put some downward pressure on equity markets, particularly those higher valuation parts of the market as well.
And we've heard from Fed Chair Powell, as well as other members of the central bank, and you were referring to this as far as at least two more rate increases this year. If we do end up seeing another one at the end of this month, what would need to happen with the data between now and then when we have the Federal Reserve's following meeting in September after the July meeting for them to end up maybe potentially having two consecutive rate increases?
Yeah, it's a good point. And look, we do get a lot of data between now and September. And of course, this month alone, we'll get an additional set of CPI and PPI data next week. We'll, of course, start earnings season towards the end of July, and we'll have that July rate hike or rate decision at the end of July. So the Fed and the markets will have to digest quite a bit. Our view is that over time, we will continue to see inflation moderate. And so perhaps the one rate hike that the markets are pricing in could be a final rate hike for the Fed. But if the economy does continue at this pace, especially in the services sectors, that could keep services inflation elevated. Keep in mind, the Fed has broken down inflation into three core buckets, which are goods inflation, which have shown signs of rolling over, housing shelter inflation, which we do think over time will see cooling, that there's a lag there, and real-time data is showing some cooling, and we think that shows up over time. But it's really that third bucket, which they categorize as non-housing services inflation, that has yet to show meaningful signs of moderation. So they'll be watching that closely, and I think if that continues to show signs at least of stabilizing, moving lower, we'll have one rate hike ahead of us. If not, that the second one is on the table.
So then as a strategist, what is your outlook for the second half of the year after we had such a strong first 6 months?
Yeah, absolutely. Look, it was a stellar first half of the year with the S&P up over 14%. Keep in mind, there have been some positives and reasons for optimism. The economic data is coming out ahead of expectations. Inflation, as we noted, is showing signs of moderation, and the Fed may be towards the end of its rate hiking cycle. But we'd be cautious to extrapolate that strong move higher in the first half to a straight line up in the second half of the year. Now, history does tell us when you are up over 10% in the first half, it bodes well for the second half. In our view, we do think bouts of volatility may be likely, especially if the economy starts to show signs of cooling. But will we get another bear market or meaningful downturn? That we see as unlikely at this point. And in fact, we think those bouts of volatility could be used as opportunities, especially as investors look towards 2024, where you could get a meaningful bounce back in earnings, better inflation, and a Fed that not only is pausing, but they've told us they might start thinking about pivoting lower as well. So really you want to start positioning for what we think could be a broader-based market rally and participation towards the back half of the year, and both in equities and in bond markets as well.
So do I think about small mid-cap stocks, Mona? They've historically lagged some of the bigger cap names, but if this thing's going to broaden out a little bit, maybe small and mid-caps.
Yeah, it's a good point. And look, small caps have meaningfully lagged in the first half of the year, so we certainly think there is room for catch up. Now, when we look historically, small caps tend to do well when the economy is reemerging from any sort of softness or downturn. They tend to lead on the way up. And so when we think about what we call a recovery basket, that could certainly include areas like small cap stocks, like cyclicals, and we're starting to see some strength in industrials, materials, perhaps even financials in that basket. International equities tend to do well in that environment. Those we think can complement what we're seeing right now, because we do think the story behind AI and growth sectors does have a long-term secular tailwind behind it, although a lot of it has been priced very quickly up front as well. So we think a complement of both the growth and the more cyclical parts of the market will work better as we head towards 2024.
We only have about 45 seconds left. What's the top question that you hear from clients?
Yeah, I think it's still the big one around recession. We tend to hear a lot more, especially now that the Fed is, continuing to raise rates. And we do think that what we're seeing now is a potential for a cooling in the economy, but perhaps not your typical 2 back-to-back quarters of negative GDP growth. We think a softness to below trend growth is likely, though, sometime in the second half of the year.
All right, Mona, thank you so much for joining us. Really appreciate getting some of your time. Mona Mahajan, she's a senior investment strategist at Edward Jones. Edward Jones, great firm, been around for a long time, St. Louis, Missouri. So it's a great firm with great research heritage. So it's good getting some of Mona's time here. Looking at the markets here, Jess, off about 1.3% on the S&P 500, a little bit about the same on NASDAQ. But again, some of the real news here is in the yield space. We've got a 10-year Treasury up 13 basis points, 4.06% on a 10-year. You do even better in a 2-year. It's up 13 basis points as well, 5.07%. So Tom Keene is triple leverage all cash fund. I mean, I think he's getting some return here.
Those Russell 2000s down more than 2%.
Yep.
So majorly underperforming.
Absolutely. So we were talking about some of the small caps participating. Not today. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, it's the arrival of a Twitter rival. Meta's Instagram app Threads rolled out today. More on that from Bloomberg's Ed Baxter.
This launches a most serious threat yet to Elon Musk's struggling Twitter. On Threads, users are posting text and links, as well as replying or reposting messages from others. Sound familiar? Well, Bloomberg's Sarah Fryer says it feels a lot like Twitter, and it is getting activity, also allowing existing follower lists and account names to be ported over from Instagram. Sarah says users were looking for an alternative to what's out there without starting over, and seems so far to be pleased.
Ed, threaders might disagree with that assessment. Some users trying to look at Mark Zuckerberg's posts were greeted with the message, content not available. Meta Platform stock is up less than 1%. The state of Nevada reaches a $285 million settlement with Walgreens regarding the pharmacy chain's role in the opioid epidemic. Walgreens was the final defendant in a lawsuit filed in 2019. The state reached settlements with Teva Pharmaceuticals last month and with CVS in May. Shares of Walgreens right now down more than 1.5%. And JetBlue is giving up on its Northeast alliance with American Airlines and will wind down the operation. The company says it won't appeal a federal court ruling that said the arrangement violates antitrust laws. Instead, JetBlue is focused on winning approval for its bid to take over Spirit Airlines. It hopes that ending the alliance with American will help its case. American says it still plans to appeal the ruling against the Northeast Alliance. Shares of JetBlue currently down 6%. American Airlines stock down more than 2.5%. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Metton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Big active day on the markets today. The S&P selling off 1.3%, NASDAQ off 1.3%, and as Jess was just pointing out before, the Russell off 2.5%. So big move in the small cappers, and of course in the rate space, we got big moves as well. 10-year up 13 basis points, 4.06% on the 10-year, and on the 2-year, boy, you're getting 5.07% on a 2-year note. Also want to take a look at the commodity space. WTI crude oil off 1.4%, sitting right above $70 per barrel. So we'll keep an eye on that. Bitcoin, Tom Keen's on here, so we'll give that a quick quote there. That's off 1.1%, still holding above that $30,000 level, about $30,140. Right now, let's head down to Washington, D.C. We're going to get world and national news with Nathan Hager.
Paul, when it comes to climate change, scientists generally track it in terms of months, years, even decades. But as Bloomberg's Amy Morris reports, the last few days have been something else.
Earth's average temperature yesterday remained at an unofficial record high set the day before. National Oceanic and Atmospheric Administration Chief Scientist Sarah Kapnick says it's an indication of where we are right now. Scientists have warned for months that 2023 could see record heat as climate change warms the atmosphere. And they noted that La Nina, the natural cooling of the ocean that had acted as a counter, is giving way to El Nino, which means warmer oceans. In Washington, I'm Amy Morris, Bloomberg Radio.
Solar energy will be in focus for President Biden. He is headed to South Carolina with a Bidenomics message touting a $60 million investment in the solar equipment maker Enphase Energy. More on that from Bloomberg Government's Jack Fitzpatrick.
This is sort of a somewhat political follow-up as the president tries to play up some of his legislative achievements, including the CHIPS bill. You'll hear a lot about infrastructure over the next number of months.
Bloomberg Government's Jack Fitzpatrick reports the investment in Enphase would create 1,800 new jobs nationwide, according to the White House. The valet accused of helping former President Donald Trump hide classified documents from federal authorities is due back in a Florida court today. Walt Nauta is charged alongside the former president and special counsel Jack Smith's 38-count indictment. He was supposed to have been in court by now, but his earlier appearance was postponed due to a canceled flight. One of the founding members of Journey has died. George Tickner was the original guitarist for the band that really took off after he left. He quit in 1975 after their debut album to pursue a medical career. Actually got a full ride at Stanford Medical. Fellow Journey founder Neil Schon confirmed Tickner's death on social media today. He was 76 years old. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg, Paul and Jess.
All right, Nathan Hager, thank you so much. We appreciate it. Jess, any work you've been doing recently you'd like to share with the class?
During my day job,
yes,
when I'm not here with you, Paul. So I did do a story this morning before I came to join you. So I was taking a look at Bank of America has a sell side indicator.
You're writing a news
well, y'all
story.
are focusing on Threads. I was looking at contrarian indicators, Paul and JT. So this is their sell side indicators. This is Savita Subramanian at Bank of America. And it actually rose by the most in June since November of last year, but it's still just off a 6-year low. And the meaning for that and the significance of it, it still signals that it's contrarian, and actually it's telling you when you're looking at this that it's currently indicating a 16% price return for the S&P 500 12 months from now. So if you think about from a level perspective in the S&P 500, that would be around 4,800 by year end and 5,200 a year from now. So this is really telling you when it comes to Wall Street strategists' outlook for the U.S. stock market, it's still a bit gloomy despite seeing some more optimism last month. Obviously, that was when the S&P 500 technically entered.
So this analyst likes to take the contrarian view.
Yeah, so this is Savita Subramanian. So she's one of the strategists on Wall Street that has turned a bit more bullish in recent months and raised her price target in the S&P 500 to 4,300 from 4,000, but still 4,300 is below where the S&P 500 is trading right now. If you look at that, that's around 43.86 right now for the S&P.
All right, folks, you can find that story and all the other Bloomberg News stuff on the Bloomberg terminal. Probably it's going to be on Bloomberg.com soon as well. So check out all of Jess Metton's work and all the folks on our stocks team to keep us smart about what's happening in the market. S&P off 1.4%. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to go hard with the smart people at Bloomberg Intelligence and Bloomberg News. Stocks to watch this morning, Meta and Rivian. So we're going to get Bloomberg Intelligence senior analyst. He covers all the tech stop, Mandeep Singh, and Bloomberg Technology host, Ed Ludlow. They're going to roundtable with us, and we'll talk about some tech space, too. And how about boxes, cardboard boxes? We have a cardboard box analyst at Bloomberg.
I want that job so bad.
So bad. I mean, we've all got boxes piling up on our front door every day.
Let's get an analyst.
Ryan Fox, he covers all that kind of stuff in the paper business, so he's going to join us and talk to us about where the box market is going. And again, that is a thing. But first, we're going to kick it all off with John Tucker on the Bloomberg Business Flash.
All right, let's start with Treasury yields spiking to levels that we last saw in 2007, and the major stock averages, they are lower. The latest data suggests the Fed has ways to go to cool the economy and the rate of inflation. You have the ADP data this morning showing companies adding the most jobs in over a year in the month of June. The biggest part of the economy also expanding in June at the fastest pace in 4 months. Well, Liz Ann Saunders at Charles Schwab among those looking for more rate hikes from the Federal Reserve.
I think they're going to go in July. It's rare under the Powell Fed for them to go against market expectations heading into a meeting. So I would expect a hike in July.
On the S&P 500, all 11 major industry groups, they are lower right now. The biggest drags coming from energy, materials, and consumer discretionary. And keep an eye on Biogen today. The Food and Drug Administration could give full approval to their Alzheimer's treatment sometime today. Right now, the S&P 500, 58 points lower. That's down 1.3% at 4388. Dow Jones Industrial Average, 490 points lower. The NASDAQ 100 down 210 points. That's a decline right now of 1.4%. Two-year yield, 12 basis points higher, 5.06%. The 10-year up 12 basis points at 4.05%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. And John, I'm just confirming once again for the market that you are not on Threads or Thread or whatever.
I am not on Thread. I think I'm on LinkedIn. That's about it. And
That's about the extent of your social platform?
That's the extent of it. You don't want me on any sort of social media.
We need to get you on Twitter.
I think I could only get in trouble. I think it has absolutely no
upside.
benefit.
I think this would be great.
For a person like me.
All right. We'll see how that plays
Trouble.
out. We'll see. Anyway, Threads is a thing. I'm there for what it's worth.
Start a campaign.
Let's do a little tech roundtable here. Let's bring in Mandeep Singh. He covers the tech for Bloomberg Intelligence. And Ed Ludlow, after a very difficult Zoom situation this morning, he is our technology guy out in San Francisco. He joins us as well. So we got it all covered for you. Mandeep, let's start with you here in our studio here. What is Meta looking to do here? Is this going to be a business for them? Is this a real competitor for Twitter? Just give us the business case.
The business case is they want to add that dimension of real-time public conversations that are going on related to politics, related to breaking news, and that weren't happening on Instagram. Probably they were happening on Core Blue app, but they've been losing engagement. So it's an engagement play for them to keep users on their family of apps. And they've done a great job of adding Reels content. This is another dimension. And look, they don't need to focus on monetization right now. If they're able to get that engagement in terms of getting the core creators from Twitter to Threads, that'll be a big win for them.
And is this likely to be a big player here, or what kind of hurdles are ahead for it?
Well, the hurdles is, the interest graph and the followers that Twitter has over the course of their last 15, 20 years. People have accumulated their followers, and they like to see a certain curated feed when it comes to the home screen. Well, right now when you go to Threads, they have an AI-generated feed, and there are a lot of brands, and I've tried to, mute a lot of them. I mean, that's not the experience you want to have, and that's where scale and network effects is what drives social media engagement. And early movers have always had an advantage. What TikTok did was great in terms of leveraging AI to come up with, great recommendations. That is the playbook here for Meta, is to use their user graph as well as AI to drive the curated content feed.
All right, Ed, when I think of cutting-edge technology, I think of Ed Ludlow. I think of Silicon Valley. And guess where Ed Ludlow is? Silicon Valley, out there in San Francisco. Ed, what's the buzz, if anything, out there in the Valley about what our good friends at Facebook are trying to do here?
Yeah, the adoption's been really interesting to track. I was signed up to Threads as user number 132,009.
Wow.
So I made it in.
Ooh, let me see where I am.
In the initial batch. I mean, Bloomberg's tech editor Sarah Fryer was like number 2,000.
Well, she's a player.
Overnight, she's a player, and overnight we hit the 10 million mark. And my understanding is that we're closer now to 30 million. Users on the platform. But I find Mandeep's commentary really interesting. There are clearly UX differences, right, between what you get on the Threads platform, what you get on Twitter. It's very simplified right now. There's no sort of ad stream on it. The biggest piece of news for me in the last 24 hours was a post by Zuckerberg basically suggesting that 1 billion users is possible. And to jump from 30 million to 1 billion, I think I know a number of sell-side analysts this morning kind of see difficulty in getting to that scale. But think about it this way. Facebook, WhatsApp, Instagram, if Meta onboarded just 1 out of every 10 users on its existing platforms, it would already eclipse what Twitter's monthly or installed active user base is. So you can kind of see them eclipsing Twitter. 1 billion? Harder to see.
Mandeep, something I'm curious about is, especially when you think of Meta and the cost-cutting efforts that it has clearly gone through, and its stock's up more than 200% since early November. How much could this potentially either support that stock price, or is it just too early to be seen when you're looking at sell side?
Well, so in terms of incremental revenue, I think, look, this is not going to move the stock. Twitter had revenue of, around $6 billion before they went private. And even if they are losing revenue and, Meta can layer ads over time, you're not buying the stock here with the hope that, this product is going to generate $2-3 billion in incremental revenue. But what it can do is drive that engagement, because ultimately, if you go to Twitter right now, their average time spent per user is around 27 to 30 minutes every day for the daily active users. If they can take a share of that, that'll be huge. Again, the cumulative effect of social media, when you think about, Meta, is what people spend their time on, the core Blue app, the Instagram, and WhatsApp. You add another dimension to it, it helps with their AI, it helps with the overall advertisers, and that is what Meta is after here.
All right, so Ed, what's the feeling in the Valley about Elon Musk? What's his response going to be? What's the future of Twitter? How do you think this plays out?
By
the way, I just did my first post on Threads telling people to go to YouTube to watch our streaming. So I am multimedia tasking out.
I will repost.
Thank you.
I will repost that. Just give me a second.
Okay.
I'm on air with you right now.
Yeah.
Look, I mean, Elon's tweeted, he said it is infinitely preferable to be attacked by strangers on Twitter than indulge in the false happiness of hide the pain Instagram. And I think his point is that historically Instagram is a photo-based app where you give the perception that your life is very different to reality, I guess from a happiness perspective. Linda Yaccarino, who is the new Twitter CEO, has tweeted in the last 30 minutes. I wouldn't call it cryptic, but I would say that she really emphasizes what she feels is good about Twitter. She doesn't specifically name or call out Threads. But, they're essentially the same thing. I'm a big meme guy, and you guys will have seen that Zuckerberg tweeted. He did his first tweet since 2012, 11 years, and it's the classic Spider-Man pointing at Spider-Man, the reference to episode 19B of the 1967 animated series called Double Identity. They're the same platform, and Mandeep may disagree with me, but to all intents and purposes, they're the same, and that's probably ahead of the cage match. upset Mr. Musk.
So Ed, do you think that it's likely that Meta would be able to take a big chunk of users when it comes to Twitter? Obviously, as you know, there's been problems that Elon has had to go through when it comes to the Twitter platform over the past year.
Thank goodness. I thought you were going to ask, is it likely that Musk and Zuckerberg actually fight each other in a cage? I think that what I notice anecdotally, I was on it for hours yesterday. It was a bit cringe fare. I sent many threads. I really engaged with people. A lot of what people were talking about is that they wanted the tone of threads to be a pleasant place, a nice place. And many of them explicitly referenced the idea that they felt that Twitter was not that way. And so, this is also playing out on Twitter in parallel, by the way, the irony. Lots of people on Twitter are talking about you're only going to threads as a vote against Musk himself because you don't like him or his personality. How can any of us quantify what kind of driver that will be for threads growth? I think Mandy's points on the future of the content on the Threads platform is the key bit.
Hey, let's just quick change gears here. I know you spoke with the CEO of Rivian yesterday, Ed. What's the key takeaway there?
Yeah, I mean, two pieces of news. One, the quarter just gone is the first time the supply chain's normalized, and that was evidenced by their output. They've made some tech fixes, and they're really starting to ramp now. And they basically suggested that they will outperform their guidance, which would be interesting for investors. The other is that he told me they're trying to negotiate with Amazon to get out of Amazon's exclusivity to buy the commercial vans from Rivian. So they say that those talks are going well, and that if they're successful, Rivian can start selling these electric delivery vans to other players. And as we know from this program, right, electrifying last mile delivery and the logistics space is a big market opportunity. So that was a really good takeaway. Check it out on Bloomberg.com.
All right, great stuff. Ed Ludlow doing all the tech stuff for Bloomberg Technology and Bloomberg News out there in San Francisco. Mandeep Singh, of course, senior technology analyst for Bloomberg Intelligence. All right, let's switch gears. This is not necessarily tech, but you think about the tech-enabled boxes that end up on your front door every single day, and everybody knows what I'm talking about.
Yes.
Let's get a sense of the business of the box business. Ryan Fox, he covers a corrugated market for Bloomberg Intelligence. So Ryan, give us a sense of just kind of the stuff you covered. Give us a sense of the industry that we all touch every day because it lands on our doorstep every day.
Yeah, so the average American is going to call it a cardboard box. In the industry, we call it a corrugated box.
Nice.
Anecdotally, like 95% of consumer goods ride in these boxes every day. So it's a very good indicator of what's going on in the economy. And, for the last year, we've seen a gradual decline in box shipments by producers of those boxes going to brands.
Who are the main players in that space?
Yeah, main players are going to be International Paper, Westrock, Packaging Corp, at least domestically here in the U.S.
And you mentioned a slowdown. What was the catalyst to that, and what would that also mean for the trajectory of the economy?
Yeah, so initially the slowdown, it was linked to these the destocking narrative that's been going on for about the last year. Most of the producers are saying their customers were pushing back. That they had plenty of inventory, things weren't moving very quickly. And some of it we saw in our data. We saw that first quarter of 2022, lead times to get boxes went out on average like 4 and 5 weeks. And this was a huge departure from the norm. The average lead time to get boxes is like 3 to 5 business days. So to have something go out 5 weeks on average was just astronomical. So when you think about a manufacturer and how they have to place their orders, this caused them to change their ordering. Some manufacturers during the pandemic had even gone to AI platforms that were initiating automatic orders even when they maybe didn't need them. And so at some point in the second quarter, they found themselves sitting on a lot of boxes that they didn't really need. And so producers saw that slowdown at the end of the second quarter going into mid-year. And it really just slowed down from there.
All right, but where are we now versus pre-pandemic? There's a lot more boxes out there, right?
So after the
dude, I'm
first
getting
quarter.
so many a day. All right, here's my thing. I'm really good at breaking down the box. As soon as it comes in and we empty it, I'm breaking that box down.
I'm the opposite.
And I'm putting it in recycling. But really, it's got to be way higher than pre-pandemic.
No.
Really?
So we're actually, after the first quarter, we were tracking with 2017 as far as the volume of boxes that was going out. Our data indicates that through the second quarter, we're probably still on that pace, maybe even a little bit behind there. And it's not looking good going in the second half.
Really? Wow, I never would have guessed that. Hey, following up on that, because I'm a big recycler, and I think this is, every time I break down a box and put it into recycling, I feel like I might be part of a scam here, that it doesn't really work. Tell us how the industry recycles boxes and stuff.
Sure. So first of all, about over 90% of all of the recycled boxes that we get, and really all recycled commodities, are going to come from commercial and industrial sectors. So we're going to be thinking about Walmarts and Kroger's and Albertsons and big retailers like that. That's where most of the old, what we call old corrugated cartons, or OCC, that's where they come from. Curbside recycling is really not great. It's about 7 to 8% of the total, and it represents about 2 million tons a year. Americans just aren't great at recycling.
I'm really good at it, but so does International Paper take my box and then redo it and send it back out to me?
That's what I was curious about, because do they do that, or also are there renewable basic materials that go into tissues and other personal care products?
Yeah, so OCC is a very highly sought commodity. It's something that we export about 10 million tons a year of to other countries. But internally, we consume about 25 million tons of old corrugated boxes every single year, and we make new boxes out of them.
Do I play these stocks? Do I play it on? I mean, is my call on International Paper just how much stuff is getting shipped around the world?
That's a great question. I mean, I don't know. I don't know the right answer to that. They're traditionally very, very stable companies. I mean, like I said, with 95% of the world's goods that consumers buy right in these boxes, it's not like they're going to go away anytime soon.
Yeah, I mean, geez, I don't know. Just by my household, it just seems like, and Tom Keene's always complaining about, his doorman's.
What are you getting delivered?
I don't know. It's
what do you
this
mean you don't know?
Shampoo comes. I mean, you don't go to the store anymore. You just click. It's crazy. So I don't know what's going on. All right.
So we did some math on it, and the average American. So if we were to take the volume of boxes that are made in an average year, divide it equally across everybody in the country, it's about 1,200 square feet per person per year. So it's
there you
a lot.
go. I'm telling you. All right, Ryan. Thanks so much for joining us, Ryan Fox. He is the corrugated market analyst with Bloomberg Intelligence. Learned a lot there, but I don't know. I feel like I'm a good recycler, but Ryan's telling me it's not that big a deal.
I think I'm hoarding too many boxes.
I'm not moving the needle. But anyway, good stuff to catch up on that part of the biz. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, FedEx wants to throw a lifeline to shippers who rely on one of its rivals. While UPS and the Teamsters Union remain deadlocked in contract negotiations, the company is encouraging shippers to switch over to FedEx now. FedEx saying that in the event of an industry disruption, its priority is protecting capacity and service for existing customers. UPS unionized workers say they'll strike if a deal isn't reached by the end of the month. Tesla and its Chinese competitors reach a truce in their electric vehicle price war. More from Bloomberg's Jeff Bellinger.
Steve, Tesla and China's top automakers pledged to maintain fair competition and avoid abnormal pricing in the world's largest EV market. They also vowed to help stabilize growth and avoid risk. Executives from 16 companies attended the signing ceremony in Shanghai today, with Tesla being the only foreign brand to join the pact. Texas-based Tesla slashed prices in China late last year, prompting other EV makers to offer steep discounts earlier this year as sales slowed down. Steve?
Thanks, Jeff. Shares of Tesla down 2.75%. It sounds like something out of Back to the Future.
Roads? Well, we're going, we don't need roads.
But it appears to be the real deal for Aleph Aeronautics. The San Mateo, California startup got the green light to test an electric vehicle that it says can fly. Aleph received a special airworthiness directive from the FAA for its Model A car. The company says its flight-capable car is the first to receive approval from federal regulators. Aleph Aeronautics is backed by Elon Musk's SpaceX. I'm Steve Rappaport, and this is Bloomberg. More coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We have stocks lower, bond yields, they are surging right now. This all follows the latest economic data that suggests we're going to see more rate hikes from the Federal Reserve. Earlier today, we had the ADP report showing the private sector adding far more jobs in the month of June than we had expected. ExxonMobil, among the individual shares, that is lower. They forecast a $4 billion hit to earnings. And then you have Meta Platforms after Instagram launched Threads, that is higher. And as yields rise, the banks are also under pressure. The idea is that banks are going to have to pay more for their deposits as the yields increase. The KBW Bank Index, that's down about 2.8% right now. S&P 500, 60 points lower. That's down 1.4%. We're at 43.86 on the index. The Dow Jones Industrial Average, 516 points lower. That's down 1.5%. The NASDAQ 100, 212 points lower, a decline of 1.4%. And as for those yields, the 2-year is at 5.05%. That's 11 basis points higher. 10-year yield, 13 basis points higher. That is at 4.06%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Well, last week, the Supreme Court struck down the Biden administration's student loan forgiveness plan, which would have done away with as much as $20,000 per borrower. And remember, the House also used the deal to raise the nation's debt ceiling to force borrowers to start paying back their loans in October, which is sooner than planned. So it's really tough on that student loan forgiveness front. Let's get the latest on what that could mean economically. We welcome Claudia Sahm, founder of Sahm Consulting, former senior economist at the White House Council of Economic Advisors, so she knows about this policy stuff. Claudia, thanks so much for joining us here. Give us your view of what kind of we saw from the Supreme Court and from Congress over the last couple of weeks as it relates to student debt and loan forgiveness and that type of thing.
All right. Student loan forgiveness not making it through the Supreme Court, I don't think that should be a surprise to anyone. When using executive powers to do $400 billion in spending. And yet this was the second of two blows to student borrowers that week. And you mentioned the repayments start sooner. And for a lot of people, that is going to be a hardship, right? Like for, the time that they've not been paying, that really eased up some space. It's coming back somewhat sooner than, administration said it was going to end too, but this is earlier. So you're not getting the forgiveness to help smooth over the period of adjusting, and you are getting your payments back sooner. So there's, it was not a good couple weeks for people with student loans.
So with interest beginning to accrue in August and then those payments needing to be paid in October, how does that affect consumer spending and obviously the trajectory of the economy?
Right. Well, so it's clearly not good for the economy. It is the case that the people themselves who are in these situations have student loans. This deeply affects them, and yet the amount of money we're talking about, like the new payments, it's really not the kind of magnitudes that really move the needle on GDP. Like in the sense that this would, or demand, and make it like the Fed doesn't have to do as much because these payments are expiring. So I think with this policy, the macro lens is less important than the people side of it.
Isn't there already something along the lines of the public service loan forgiveness program? Can you tell us what that is, how that works, and how that might, help more people kind of deal with their student debt?
Well, in my piece, I made the point, it's like, look, we're at a time where you've got a moment of reflection in how you go forward. President Biden said he's going to try and keep figuring out how to do this. And it's also a time where they could take stock and say, hey, let's look at some other forgiveness programs. What didn't go well, what did go well. And the one example that I talk about are these, the debt forgiveness to people who work in public service of any form. You can think of as teachers, doctors, firefighters, right? There's a big group. And in fact, the group that would qualify for these loans is big in terms of jobs of the economy. It can almost be 25% of jobs. That's not to say all those people are eligible and they have student loan debt, but this is not a trivial subset. And one of the things that they've really struggled with, that the Biden did not, is setting up a plan where people actually get the benefit at the end, right? They have a low take-up rate and they have a low success rate. But it's a complicated program. You got to pay back 10 years. So there are things there but the Biden's forgiveness plan, the sign up for it was so fast and massive. So there's lessons to be learned there. And I mean, there are functional parts of that student loan setup. So that could also, I think there could be a real exchange of ideas that would be fruitful, both for the forgiveness plan we actually have and the thinking about, well, what would be next for a student loan forgiveness.
When it comes to the inflation front, there were concerns among macroeconomists about how the potential forgiveness could potentially spur a spark in inflation. What do you think this means when we're looking on the inflation front moving forward?
We're talking about basis points, right? Like, yes, it will probably have an effect. Yes, it probably did allow spending to be a little higher as you didn't have to do the payments. With the student loan debt, that's forgiveness, that's even less applicable because it's spread out over 10 years, like the whole process. And it's, yes, it will have an effect on demand, depending if it's there or it's taken away. And yet that's not the argument that should bring down a program like this, is the inflationary effects.
So, Claudia, we have received a lot of economic data, including today, that suggests this economy perhaps is stronger than people think, that perhaps a recession is not right around the corner. I would love to get your recession outlook. Maybe talk to us about something called the SOM rule.
Yeah, what's that? No. So I've said several times last year when the recession talk was really getting going, and it's like we need to hope that labor market is as strong as the Fed keeps complaining that it is, right? Because if it's strong enough, it can buffer. And, and slowly there are other things related to the pandemic, to the war in Ukraine, that as those work through, we could have inflation come down without the Fed doing more and more and more. But they're going to keep pushing. So the labor market being strong is good for people without a doubt, but it also can just buffer us so that we slowly rebalance, we slowly get inflation back down, as opposed to, bam, there's a recession and everything falls, including inflation. So I think the labor market is extremely important in that regard. And in terms of my recession outlook, I really am kind of on the fence, right? For a long time, I was optimistic that we could have a soft landing, in some maybe soft-ish type landing. When we had the disruptions in the banking sector, I think that caused more concern that, we may really not pull this off, because the Fed has put a lot into the system in terms of rate hikes, and they have bank failures putting more in. So but I agree with you, as the latest data on the economy comes in, it looks pretty good.
And especially on the back of that ADP data that we got this morning, JOLTS, and then ahead of tomorrow's jobs report, what's your view as far as the strength of the labor market and what it could mean for the Fed's decision later this month?
So I think we're going to continue to see an expanding labor market. I mean, no, not every month, right? We could have a big downside surprise this time because, we've had upside. But I think, when you look broad brush and you look like recent months, not just like today and tomorrow kind of picture, I think we're seeing what the Fed said it wanted to see, which an economy slowing, just like people not spending so much, not people coming back to work so they don't have to pay the wages quite so much. So we'll know more. We're going to know a lot more about the labor market by Friday. But at the end of the day, the Fed is going to look at inflation. Right? They get one more CPI before their meeting, and that is going to take precedent over anything else that they're learning because inflation's too high.
So, I mean, a lot of folks will say, we had Danielle DiMartino Booth from QI Research Consulting in here earlier today, and she was saying she thinks the economy is much slower than the headline data is suggesting, some of the data sets she looks at. Is your sense that the economy is in fact slowing down, and is it material?
Well, if you think about the increase in payrolls this year compared to last year, they have slowed down. They're still really good. in terms of relative to before the pandemic. So, I mean, getting 200,000 jobs a month, that was pretty standard before the pandemic. So we need to get, and I think we're moving this way. There's enough rebalancing that we're starting to see things get kind of back to quote unquote normal. And I think the labor market has behaved much more in that way than inflation's been a lot harder for people to square the data.
All right, Claudia, thank you so much for joining us. Claudia Sahm, founder and independent economist at Sahm Consulting, former sector chief at the Federal Reserve Board, former senior economist at the Council of Economic Advisors at the White House. So lots of experience there in terms of economic policy at the highest levels. Again, the economic data just today, I mean, it seemed, very strong, and we're seeing that reflected in the bond market.
Especially the 2-year.
Yeah, sure, 5.06%, and that's kind of putting the dampers on the stock market down 1.25%.
Yeah, and those losses being led by energy down about 3%. Just looking at about oil prices, still a little bit above $70 per barrel, but still down about 1% today.
Yeah, so we'll have the full coverage tomorrow of the jobs data. Again, non-farm payrolls expected to add about 225,000 jobs. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
A little bit of breaking news here, Paul. A former White House aide turned valet to former President Donald Trump has pleaded not guilty to federal charges. Walt Nauta made a brief appearance in federal court in Miami this morning to answer to special counsel Jack Smith's indictment in the classified documents case. Nauta is facing 6 counts, including conspiracy to obstruct justice and concealing records. His arraignment had been delayed twice before, in part so he could find a Florida area attorney. For the last 3 days in a row, planet Earth has been hotter than ever. According to the University of Maine's Climate Reanalyzer, the average global temperature yesterday was 62.9 degrees. That matched a record set the day before, which beat a 62.6 degree global temperature the day before that. University College London climate scientist Chris Brierley says it's not a surprise to see these records fall.
But that they are being broken at ever-increasing magnitudes is itself quite concerning.
University College London's Chris Brierley. Meantime, Europe's Copernicus agency says June was the warmest month on record in data going back to 1991. Sweden is making a last-ditch push to keep its bid to join NATO alive. Prime Minister Ulf Kristersson plans to meet with Turkish President Recep Tayyip Erdogan on Monday ahead of the NATO Leaders Summit in Lithuania. This is NATO's Secretary General Jens Stoltenberg.
Ratification of Sweden's membership does not mean the end of cooperation with Turkey. Far from it.
NATO's Jens Stoltenberg's meeting today with Swedish and Turkish officials. Turkey's blocked Sweden's ratification, saying it's not doing enough to clamp down on terrorists. There's been new violence in the West Bank. The Israeli army says a Palestinian man opened fire near an Israeli settlement, killing one person before Israeli forces shot and killed him. This comes a day after the end of the largest military operation in the West Bank in 2 decades, aimed at cracking down on Palestinian militants. Global news powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The data in the driver's seat today: job creation, service sector activity, strengthening the conviction that the Federal Reserve is going to have to resume hiking interest rates later this month. ADP saying U.S. companies adding almost 500,000 jobs last month. And then you had the ISM Services Index, services, the biggest part of the economy. That rose more than expected. The two-year yield, as a result, that is up right now 11 basis points, right now at 5.05%. Every major industry group in the S&P 500 lower right now. Earlier today, Charlotte Ryland at CCLA Investment Management was asked where she is still finding opportunity.
Technology is still a sort of large area of our portfolio. Yes, a lot of those names have run pretty hard so far this year, and we've been taking a little bit of profits, but we still think, the long-term picture for, whether it be semiconductor usage or whether it be some of the big cloud providers like Microsoft still looks pretty good.
Ford Motor Company's electric vehicle sales falling 2.8% in the second quarter. They're losing ground to Tesla and General Motors. Ford sold 14,800 EVs in the 3 months through June. That's down from just over 15,000 a year earlier. Ford shares right now down just about 2.5%. Overall, the S&P 500, 54 points lower. That's down 1.2% at 4392 on the index. Dow Jones Industrial Average, 475 points lower. The NASDAQ 100 down 181 points. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
All right, certainly is. John Tucker, thank you so much. We appreciate it.
We just found out Paul's the fashion police here.
Oh, yeah. Dudes cannot come into this office with shorts and sandals.
You better show up in a suit and tie.
I love it. Now I feel
I know.
self-conscious.
You better show up with a tie tomorrow, JT.
No, that ain't gonna happen. On a Friday in the summer?
Especially on a Friday. Paul's very bullish about in-office on a Friday, but apparently you also need to have a suit on.
Well, in Friday, I'll wear some golf gear just in case if somebody's walking by the studio heading to his or her private jet to fly to Bermuda and needs a fourth for golf. I'm there for that person.
You're there. Now, in the investment banking world, was it always suit and tie?
Yeah, until the dot-com bubble, then the casual thing came in.
Yeah, I remember them up on stage.
When I worked at the Chase Manhattan Bank in the early 90s, you could not leave your desk without putting on your sport coat. Big time.
And if you were caught without your sport...
You would get reprimanded, which happened to me in an elevator once.
Paul got triggered when someone showed up with sandals in the Bloomberg office.
That just kills me.
All right, it's Thursday. Let's get to our good friend Barry Ritholtz. Always well dressed, always carries himself very well. He's a host of Masters in Business on Bloomberg Radio. He's also got a day job, Chairman and Chief Investment Officer of Ritholtz Wealth Management. Barry, I have no idea what to talk about today, so I'm going to throw out a word and you just kind of react. Inflation. What's going on out there? How should we think about it?
It peaked over a year ago. It's coming down, and the areas that are not coming down, you could blame the Fed for causing a shortage of homes for sale and higher apartment rentals. Other than that, everywhere we look, we see either falling prices. Look no further than the used car wholesale market and used car price market has come down to luxury goods. The index that Bloomberg tracks of luxury watches have peaked and fallen 20-25%. So wherever we look, inflation is rolling over. The three sticking points are labor, and I don't see how higher rates are magically going to make 1 million more workers appear in the United States. Semiconductors, same. And housing. And housing is where the Fed is actually making the situation worse. Perversely, the Fed is causing higher inflation. And the sooner they realize that,
how are they doing that, Barry?
Will all be.
What do you mean by that? How are they doing that?
All right, so two major ways. The first is owner's equivalent rent is the largest part of CPI. What is it? It's effectively what it costs to rent your house if you wanted to rent it out. And when mortgage rates go higher and there's an insufficient supply of single-family homes and home prices go up, guess what happens to rental units? They go up also. Second, there would be many more homes for sale, perhaps easing the price pressure we've seen both in purchase and rentals, if people didn't feel locked in to, hey, I have a 3.5%, 4% mortgage. If I go out and get a new mortgage at 6.5%, 7%, it's going to cost me a whole lot more for not a whole lot more house. We're better off staying where we are, says so many homeowners. And hey, we'll add a pool, we'll redo the kitchen, we'll just do some renovation, which, by the way, indirectly contributes to all these rising prices for contractors. So many people have been doing that over the past couple of years. They're making that more expensive. If you want lower inflation, not only should the Fed stop raising rates, they need to think about sliding back a cut or two in order to stabilize the rental market, which they are directly disrupting.
And your latest column on the Terminal is about how more inflation expectations, silliness that you were writing about. So you're thinking that we aren't going to see higher inflation, but given what you were just talking about when it comes to especially shelter and housing, how you have different components when you're looking at inflation metrics, especially with CPI, right? Because shelter is more of like around a third of the weighting. Very different than, say, when you look at PCE, right? Which has a very different weighting there.
That's exactly right. So first, forget expectations. When we look at goods prices, not only have they stopped going up, many of them have come down in price, and quite a few have fallen to levels that were pre-pandemic. When we look at lumber, when we look at a number of industrial metals, when we look, pretty much across the board, even energy, where are we? 68, 72 a barrel? That's what it was in 2006. So I'm okay with oil being the same price for 20 years. Yeah, it fell, it spiked, it collapsed again, but it's hard to say that we're really paying way too much for energy prices. Natural gas prices continue to drift lower despite the Russian invasion of Ukraine. So when we look at what's actually happening, prices are either no longer going up or going up much more slowly or actually coming down. But the Fed likes to do this thing called inflation expectations. They survey a few thousand people and they say, where do you think inflation will be in 5 years? And there really is one honest answer to that. How the hell do I know? Anything else besides that is a lie. So when people say, we think inflation is going to be appreciably higher in 5 years, all they're really revealing is their experience the past 3 to 6 months. And human psychology is that's on a lag. It took people a little while to recognize why inflation had started to tick up, which is why inflation expectations throughout the first half of 2021 were like, yeah, where inflation's fine, just as it was spiking upwards. And then last summer, when it had peaked and reversed, people maintained their same much higher inflation expectations for a few years. Humans are terrible at predicting, and random people telling you what CPI will be 5 years from now. I know there's been a lot of medical experiment with psilocybin and magic mushrooms. I didn't know it had actually reached the FOMC research department, because that's the only explanation for this sort of survey.
All right, Barry, we're getting to the dog days of summer. What are you driving these days?
So in the last year, I picked up, it's funny to talk about this without Matt around.
I know.
I picked up an old 911, a 1988 Cabrio that the previous owner had just beaten the hell out of. They had been racing it, and they had modified it. So I was able to pick it up for really, deep down inside, I'm a value investor. So anytime I get a chance to pick up a Cabrio cheap, I did that. And I've slowly been bringing it back to stock. And as we're working on the car, by dumb luck, it turns out that it's the M491 special edition, which is the 911 turbo. It has everything the turbo has minus the turbo. So the whale tail, the fat fenders, the big tires, beefed up suspension and brakes. It's just the turbos were known as widowmakers. They were notoriously dangerous. So this is everything minus that. And I actually just brought it in. The last things I'm having done is the suspension return to normal. Okay. And that's kind of my fun summer driver. You could pick up, everybody looks at these expensive cars.
Right.
If you
do work, you can get them at a decent price. All right, Barry. Thanks so much. Barry Ritholtz there giving us the car talk. This is Bloomberg. get some company news right now with Steve Rappaport.
Paul, shares of Ford are down more than 2% after the automaker reported U.S. vehicle sales climbed 11.2% in the second quarter. Ford lost ground to Tesla and GM, though, in the electric vehicle race, with EV sales falling 2.8% in the quarter. Ford has said it expects to lose $3 billion in its EV business this year. The state of Nevada reaches a settlement with Walgreens regarding the company's role in the opioid crisis. Bloomberg's Dan Schwartzman reports.
Steve, the $285 million settlement stems from a 2019 lawsuit filed by Nevada's Attorney General. Walgreens was the last defendant in that case. The state reached agreements with Teva Pharmaceuticals last month and with CVS in May. Drug makers and distributors have been accused of turning a blind eye to the dangers of opioid abuse while flooding the market with painkillers. Settlements related to the opioid epidemic have totaled more than $50 billion nationwide. Steve?
Thanks, Dan. Currently, Walgreens stock is down more than 1.5%. And Meta Platforms says more than 10 million users signed up for its new app Threads in today's launch. Threads is designed to be a direct rival to Twitter. Meta CEO Mark Zuckerberg in Threads wrote, "There should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but hasn't nailed it. Hopefully we will." Zuckerberg's message didn't quite resonate with some users, and that's because they really couldn't see it. Instead, users pulling up Zuckerberg's Thread profile were greeted by a content message of being not available, although a Facebook spokesperson says that some posts were available, at least on the web version. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Men, Paul Sweeney here in the Bloomberg Interactive Broker Studio on a busy day. Lots of economic data moving the markets here. The S&P off 1.2%, NASDAQ about the same here, 1.3%. And again, big moves in the Treasury market. We've got the 10-year Treasury up about 10 basis points, 5.05%. You get in there for a couple of years. And on the 10-year front, up 14 basis points, 4.07%. Oil pulling back a little bit, sitting around just above $71 per barrel. And Bitcoin kind of steady here at $30,400 per token. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul, this week has been quite literally the warmest on record. The average global temperature hit 62.9 degrees yesterday. The University of Maine's climate reanalyzer says that matched a record set Tuesday, which beat another record, 62.6 set the day before. Mark Chenard with the National Weather Service says the highs across the country this week have been pretty eye-popping themselves.
From Sarasota was 99, and then just north of Orlando at Leesburg, Florida was 98, which were both records for the day. Phoenix was 111 yesterday, which wasn't a record, but still was one of the hotter temperatures from a major city.
Mark Chenard at the National Weather Service. As far as the global temperatures go, Europe's Copernicus Earth Observation Agency says last month, June, was the warmest month on record in data going back to 1991. Donald Trump's valet, Walt Nauta, has pleaded not guilty to charges that he helped the former president hide classified documents from federal authorities. Nauta was charged alongside the former president last month in Special Counsel Jack Smith's 38-count indictment. His arraignment was supposed to happen twice before, but he has struggled to find a Florida area attorney. He does have one now. There are new doubts about the deal that ended the mutiny attempt in Russia last month. Belarusian President Alexander Lukashenko says Wagner Group leader Yevgeny Prigozhin is back in Russia, may even have returned to Moscow. Under a deal brokered by Lukashenko, Russian President Vladimir Putin agreed to allow Prigozhin and any of his Wagner followers to go to Belarus without facing criminal charges. In Ukraine today, Russia fired cruise missiles on the western city of Lviv. Ukrainian authorities say at least 5 people were killed in an apartment building. President Volodymyr Zelensky is promising a strong response and pushing for even more support from allies.
F-16s or any other equipment that we do need will give us an opportunity to move faster, he said, to save more lives, to stand our ground for a longer time.
President Zelensky spoke with ABC's Martha Raddatz before the attack in Kiev. More than 6,000 congregations in the United Methodist Church have gotten permission to leave the denomination. That's about a fifth of the total in the U.S. It's the latest move in a widening dispute over theology and the role of LGBTQ people in the second largest Protestant denomination. United Methodist Church law forbids gay marriage or ordination of out homosexuals, but many conservatives have decided to leave the church already. Many congregations are defying those bans. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Jess.
Thank you, Nathan. We appreciate it. And Paul, I know when we talk about the CFA exam, one of the most grueling tests, 3 levels. We were just talking about level 1, that pass rate about a week ago. Now we're looking at the CFA level 2 exam. So the success rate actually jumped above its historic average to right above 50%. So it's up from about 44% success rate for those who had taken the exam in November. And then it was around 40% back in August. But we've talked a lot about how during COVID in particular, we saw just the pass rates were so much lower, just given the hurdles and obstacles that students obviously had to face when it came to those tests as far as what was happening there with COVID.
Yeah, it's good to see those numbers coming back. You know, when I was managing research analysts on Wall Street, I kind of, when young folks would come and ask for advice, I would suggest either the CFA or an MBA for really a rigorous training. The CFA is so good and it's very difficult, and the candidates have to study so hard, so many hours. And the worst part about it was, back in the day, it was only offered in June. So those nice spring days and weekends, you had to study for the exam.
No
June.
fun in the summer.
Now I think they offered around more dates, but so some good news seeing those numbers come back. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we have some good stuff. Student loan legal outlook. Janet Lauren, reporter for Bloomberg News, she covers all the higher education stuff. She's got a great note out that a story out that I've been sending to all my Harvard buddies because she's going to join us in studio to discuss her piece on Harvard being targeted by a Massachusetts bill on legacy admissions. And boy, that is a big, big issue for my Harvard buddies. So we'll check in with that. Plus, G.J. Hart, CEO of Red Robin Gourmet Burgers. How about that? Going to discuss the burger business and price rises, inflation, all that kind of stuff. Who doesn't like a good hot dog and hamburger on the grill here? So, but let's kick this whole thing off with Charlie Pelling, Bloomberg Business Flash.
Thank you very much. We got to begin with the 2-year yield, 5.04% right now, with a 10-year 4.06%. Stocks are falling. Treasury yields spiking to levels last seen in 2007 as strong private hiring data fuels bets that the Fed will have to become more aggressive in its battle against inflation. The S&P now down by 49 points, drop there of 1.1%. The Dow is down 449, drop there of just about 1.3%. Nasdaq down 173, down 1.2%. Nasdaq 100 index down 175, a drop there of 1.1%. We got more on the markets coming up in just a moment with our Abigail Doolittle. So stocks are falling, Treasury yields rising across the curve after the ADP report, and also we got data showing the service sector expanded in June at the fastest pace in 4 months. Reaction to this morning's ADP data from Michael Green, chief strategist at Simplify Asset Management, who was interviewed right here on Bloomberg Markets.
Candidly, when we look at the jobs data today, certainly coming from the ADP, I have to confess that I'm caught off sides in terms of that strength. I cannot reconcile the data.
And you can hear more of that conversation with Michael Green on the Tapes podcast. You can download it wherever you get your podcasts. ExxonMobil says lower natural gas prices and refining margins will reduce second quarter earnings by about $4 billion compared with the previous 3 months. ExxonMobil shares, they are down now by 4% among some of the other oil stocks that we track. ADRs of BP, they're down 2.2%. Chevron now down by 2.8%. EOG Resources down 2.7%. Pioneer Natural tumbling by 2.6%. Bottom line here, a lot of red on the screen, but the 2-year and the 10-year worth repeating. We've got the 2-year yielding 5.04%, with the 10-year 4.06%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Abigail Doolittle getting a Charlie Pellet shout out. That's huge.
I love that.
I mean,
thank you so much, Charlie. I really appreciate that.
That's good stuff. All right, Abigail, you cover the markets for us today. A lot going on out there. Stock market, bond market, commodities. Things are moving.
Yeah, they certainly are. And the interesting thing is whether or not we will see stocks stay down as the day goes on. Because I have a feeling, and it's just, having watched markets for much longer than I would ever care to admit, that we could see stocks really pair these losses, maybe even flip higher. But if that were to happen, the degree of selling that we've seen today, the volatility to the downside on that big, big move to the upside that Charlie was talking about for yields, that 2-year yield in particular, plus the 5-year yield up 15 basis points, the 7-year yield up 15 basis points as well. It's now here. So when you start to see intraday volatility, generally it continues. Volatility will even build more. And of course, we have the jobs report tomorrow, CPI next week. We have the Fed and earnings. So there's no lack of events to drive.
No break.
Yeah, the possibility for this type of volatility. Technically, I continue to believe that we're probably going to see the volatility move toward the downside.
And just looking at these industry groups within the S&P 500, especially when it comes to energy, leading the losses here, down about 3% in the S&P 500, followed by consumer discretionary down close to 2%. But I mean, funny enough, you look at technology, only down about 0.8%, come a little bit off of the lows there. What do you make of the dynamic versus the cyclical corners of the market versus, say, these more riskier growth corners?
I love that you're asking that question, Jess, because when I was talking about the S&P 500 sectors on the open this morning, it was interesting to me that the tech sector, while down, it was one of the outperformers while some of these other sectors were down more. Now, earlier we actually had real estate down the most, and that has everything to do with the fact that the dividends look less attractive when yields go higher. As far as energy being the worst sector right now, down 3%, I love that you're asking that question because that, of course, is ExxonMobil. And to the best of my ability to determine, they essentially pre-announced to the downside in a statement that they released yesterday, which is kind of an interesting way to do it. But they're talking about the idea that their net income, that there's going to be a shortfall. You and I and Paul, we've been talking about the idea that this upcoming earnings season, it might somehow be funky. It's hard to exactly figure out what that's going to mean. But this is an example of what I'm talking about, surprises of some sort. If you have enough companies that the tone is not great, the outlook is not great, what does it mean? Well, right now it means that ExxonMobil is down, the last time I looked, 4%, and I'm putting in the SINS function to figure out what that means relative to its recent trading action. You know, this stock for a while had been putting in record high after record high, but that actually has really not been the case for much of the year, having to do, of course, with the fact that oil is lower. And that's another interesting point to think about because oil, the Bloomberg Commodity Index down about 10% on the year, the S&P 500 up about 15%. When you have that kind of divergence between two groups of risk assets, it's unlikely to hold. I think that the commodities often are a tell to the downside, another fancy way of saying that stocks may be weak at some point.
And then what are small caps telling us? I'm looking at the Russell 2000 down more than 2%, so well underperforming its larger counterparts when you put that in relation to the S&P 500, NASDAQ 100 as well, just down about 1%.
Yeah, I love that you're asking that, Jess. So because of course I'm pulling up the chart and that index going very much back down into its range, suggesting that the S&P 500 is going to do that, suggesting that Apple, which is obviously the world's largest company, no longer above that $3 trillion market cap, but still very, very large, that you're going to see a technical breakdown. The Russell 2000 almost back down on the convergence of its moving averages, which tells you that this marketplace around small cap investors, they're completely uncertain. They don't know what to make of all of this data. But I believe that the Russell 2000 is almost about to take out its last low, which tells you buyers are unwilling to step up for these small cap, domestically more based, growthier companies. That's probably not great. But when we put that into the context of this hot jobs report, it doesn't entirely make sense. Also, we've had these ISM numbers. Well, the manufacturing number, that was a big disappointment, but services fine. Yeah, I don't know. Lots of different factors, and I think that that's why there's some uncertainty. And I think that's also why there's been a lot of bears sticking around out there, wondering, like, how can you have the NASDAQ 100 up 40%, its best first half ever, which you had made the point of last week or the week before, and yet have, you know, some data points that don't quite make sense.
Yeah, just amazing marks. I'm looking at just the Dow Transports, for example. That's also up about 15% year to date, and that's usually a nice
Dow
confirming.
theory.
Yeah. So we'll keep an eye on all that stuff. Abigail Doolittle, thanks so much for joining us here in our studio. Abigail Doolittle, she follows all the markets for Bloomberg. We appreciate that. All right, here is a story that I've been sending to all of my Harvard buddies. They're not happy for a variety of reasons. And I'm blaming our next guest, Janet Lauren. Janet Lauren, higher education finance reporter for Bloomberg News. Harvard targeted by Massachusetts bill on legacy admissions. Janet, give us a backstory here. What's going on?
So this bill has been introduced. There was a committee last week, but the question is it going to have an impact? So the question is, does the state would like to tax schools based on their endowment per student, and we know that there's a school with a quite large endowment in Massachusetts. It's a big target, and this would give schools, community colleges money based on formula for endowment per student if they have legacy admissions, and that means if your parent went to school there, do you get a preference, and also early decision. And why does early decision make a difference? Typically, students who apply earlier tend to be wealthier. They're not necessarily waiting to compare financial aid packages when they get them in March. So the question is, Harvard, again, is always a big target. There's been legislation in Massachusetts before to try to tax the endowment, also at Yale, and they have not been successful. They're huge drivers of money, universities. And the Higher Ed Association in Massachusetts said, look, if this goes through, our students, our citizens are unfairly targeted because these policies potentially could go away.
What historically has been the catalyst to prevent those types of policies from actually going through?
Well, affirmative action in the Supreme Court decision has really prompted this. If the Supreme Court says you can't give a preference for race, why should you have a preference for wealthier applications? Is what this is bringing out.
Interesting. I noticed in your reporting that the Massachusetts bill, or the second richest college in the state, Massachusetts Institute of Technology, MIT, wouldn't pay anything because it doesn't use binding early decision policies or legacy preferences.
Yes.
I didn't know that.
Yes, that is true. MIT has long had a policy not having legacies, but MIT was one of the first schools to actually bring back the SAT, and MIT is they're pretty different because you kind of have to do the work. So it doesn't really matter if your parent went there. They're looking for kids who can excel in math and science, and that's not going to be just anybody. And they also, many of the schools do not have binding early decision policies. Harvard, Yale, Princeton, Stanford, MIT, that was done more than a decade ago to take out that advantage. In fact, several years ago, schools actually abolished early decision like Princeton, and few schools followed that. And they said that they were actually losing kids because they do like to shore up where they're going to school as early as possible.
How have these poor community colleges been impacted in the past when these policies haven't gone through?
Well, community colleges are really quite underfunded. I was talking to one Bunker Hill Community College in Massachusetts where they have more than 10,000 students, and their goal is to get kids to graduate an associate's degree, ideally transfer to a four-year college. And the worst scenario is when you have some college, you've taken on some loans, and then you don't finish. And they're traditionally quite underfunded.
It's interesting because we were just talking to John Tucker about this, going to a community college for a couple of years, then you can transfer all your credits, say, in the state of New Jersey to Rutgers, which is the state university of New Jersey, Sanjay. And then you can graduate with a Rutgers degree with only really 2 years of a Rutgers tuition.
Yes. Well, and really, the biggest issue when you're talking about student loans is when you have some college and you don't have the degree, but you're carrying this loan burden for a long time. And certainly people think about community college as an alternative to having a couple of years of less expensive school. And as you said, transferring, you're still having the Rutgers degree, and plus, real experience.
As far as putting it into perspective, just how challenging is it, and how many students end up not actually being able to accept and go to a university like Harvard just because of the increasing costs? Like, say if you don't have that kind of connection there where you're part of a family and an alumni group like that.
Well, Harvard for a long time has been trying to increase its financial aid and target it to lower income students. So our story last week talked about the incoming class. 25% have incomes of $85,000 or less. And that's something that they've been particularly trying to target in the last several years.
How important are the legacy programs to the universities? I mean, it's a broad discussion point, but it seems like they're quite important for just, support and all that type of thing.
Well, the University of Pennsylvania used to say, look, if your kid wants to go here, you went here, you have to apply early, and that's the only place where you're going to have an advantage in the early decision process. But colleges like to, preserve their communities. They like to encourage alumni to donate, and we had a comment in one of the stories earlier this week that legacy programs do encourage people to donate. You're giving to your college for 30 years with the hopes that your kid might get in. That's that is some revenue that schools don't want to curtail. And certainly we're also talking about wealthy donors too.
Right. And what's the likelihood that when we're talking about these admission policies that they would actually likely go through this time around?
That's a good question. You talk to the higher ed lobby, you talk to observers, and they say, well, it's not that they have zero chance. Maybe they're, but before they had zero chance, maybe it sounds a little bit more interesting with the Supreme Court. But you have to understand that colleges in Massachusetts, there's a lot of rich colleges in Massachusetts, and you cannot undermine the power of lobbyists. colleges for a long time resisted the federal tax on endowments. It's something that a lot of congressmen were interested because, Harvard has $50 billion. Yale has $41 billion. Yeah. These are massive asset allocations, and they're a rich target. But ultimately, except for the federal endowment tax that went through in the Trump tax cuts of 2017, they've never been successful.
Talk to us about another topic that I know you're familiar with, which is we're seeing here the rich get richer, whether it's endowment or students, and maybe the poor get poorer in terms of some of these underfunded schools, underendowed schools, literally going out of business. How's the playing field these days? What's happening out there? What do higher education folks think is going to be the trend?
Well, there are a couple of trends. The first one is you had pandemic money that certainly gave a huge lifeline to colleges for several years, and that's going away. You have what we've been writing about for a decade, demographic shifts. There are just fewer 18-year-olds out there. There's fewer kids to go to college, and kids tend to go 200 miles away from their homes, and there's a lot of colleges in areas that are constrained, such as the Midwest and the Northeast. So you have all these issues converging at the same time with the price is expensive. Are people making different decisions not to go to college? So, when the price tag could be $70,000, $80,000, now keep in mind that's not actually what most families pay, because most of the smaller liberal arts colleges, they do offer aid. So the sticker price is really not what they're paying. But it's a good question. We're starting to see, there was a college in New Jersey that has now since merged with Montclair State. It was Bloomfield College.
Right.
So I think you're starting to see more of that. And, as you see schools looking for debt, their ratings are constrained.
Yeah.
Right, especially when you think of just in the context of COVID as well, which what you were mentioning, the haves and the have-nots, and how that can exacerbate that. Well, great. Well, thanks so much for taking the time to speak with us. Janet Lauren, higher education finance reporter at Bloomberg News, talking to us about, obviously this was a big topic you were looking forward to speaking to, Paul, as far as how Harvard is targeting this Massachusetts bill on legacy admissions and what that could mean, obviously, for endowments, but then also on the poor side of things when we're talking about community colleges.
Yeah, and I kind of feel like the well-resourced families will find a way around whatever blockades or kind of challenges are put up by colleges in
clearly
terms of some of these things.
Right, they've historically done, and with the lobbying efforts.
Yeah, but we thought about the Supreme Court case coming down. Somebody wrote in, being a really good essay writer is now going to become even more important because you want to say, as an underprivileged, blah 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 blah, I overcame these, and that's kind of the way to.
But then you also have to kind of think about the haves and the have-nots.
Yep, absolutely. It's been a big issue, and but again, the community college schools have been such a great route for so many people over so many years. You'd like to see that continue. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Hi, Paul. Eli Lilly's stock is back in positive territory after spending much of the session in the red zone. Yesterday, the drug maker became the world's biggest healthcare company by market value, surging ahead of health insurance giant United Health Group. Eli Lilly's climb has been fueled by its lineup of drugs to treat obesity, led by Mounjaro. That drug is already approved for treating diabetes, and the company says Mounjaro has succeeded in a second final stage trial in obesity. You don't have to wait until next week to get a peek at Prime deals. More on that from Bloomberg's Gina Cervetti.
Amazon is gearing up for its Prime Day sales event to be held next Tuesday and Wednesday, and the company said that starting today, members can preview a selection of Prime Day deals and save it to their watch lists. Not to be outdone, Target today announced deals for the back-to-school season, with 2 separate events tied to its free Circle loyalty program running over the next 2 weeks. And the retailer said it's expanding its Teacher Appreciation Discount event, which runs from roughly mid-July through late August.
Thanks, Gina. Shares of Amazon are up. Target stock is down. And Subway is making a move to bring freshly sliced meat to its sandwich chain locations, and in the process unveiling a bunch of new sandwiches. It's spending $80 million to add deli slicers to all of its 20,000 locations. Until now, the meat was sliced by a supplier and delivered pre-sliced to Subway restaurants. Competitors like Jersey Mike's, for example, tout the fact that their meats are freshly sliced. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg. Stay tuned for more Bloomberg Markets. That's coming up right after this on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, NASDAQ all trading in the red. But we begin with the two-year yield now at 5.04%. We've got the 10-year at 4.05%. Stocks are falling. Treasury yield spiking to levels last seen in 2007. A strong private hiring data, ADP, fuels bets that the Federal Reserve will have to become more aggressive in its battle against inflation. The S&P selling off down 46 points now, a drop of 1% to 4,400 even. We have got the Dow down 451, a drop there of 1.3%. NASDAQ down 157, a drop there of 1.1%. The Russell 2000 index of small cap shares being hit even harder. It is down now by 2.2%. Bitcoin down 0.4%, 30,336 right now on Bitcoin. Spot gold down $5 the ounce to $19.10, and West Texas Intermediate crude down 1.2%. WTI now at $70.94 a barrel. FedEx says that, quote, in the event of an industry disruption, its priority is protecting capacity and service for existing customers, but it does say it welcomes shippers from UPS. We've got UPS shares down by 1.1% right now amid labor strife there. FedEx shares down by 0.3%. Again, recapping here, the Dow, the S&P, NASDAQ all lower. S&P down 1.1%. That two-year, though, certainly worth repeating at 5.04%. The 10-year, 4.05%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate it. As always, Jess Met and Paul Sweeney here in the Bloomberg Interactive Brokers studio. This Abigail Doolittle, she's very good.
She's incredible.
She's incredible. She came in here, a little while ago and said, hey, I think we might just have seen the intraday lows and might trade up a little bit in the afternoon. And here we are. We are off the intraday's lows. Stood down 1% as Charlie was just reporting, but a little bit better than we were.
Right.
So we'll see how we end up this afternoon.
S&P almost right at 4,400 again.
Yep. Nice round numbers. That's easy for simple people like me. Other people do some more analysis, and that would be Tracy McMillan, head of global asset allocation strategy at Wells Fargo Investment Institute. Tracy, thanks so much for joining us here. Boy, we had a lot of eco data over the last couple of days, and we're getting some more tomorrow with the labor market. We've got some CPI next week, and then, oh, by the way, we have earnings and stuff. So A person like you who looks at this market holistically, how do you put it all together, and then what do you kind of come up with at the end?
Sure, yes. We did have a lot of data today, and the data we got seemed to have spooked investors a little bit this morning with the ADP payroll data coming in stronger, ISM data both coming in stronger than expected. Bonds are selling off, and that's really, to us, confirmation that the Fed has more work to do. Markets seem to be coming to terms with that. In summary, it just seems like the porridge just got too hot for Goldilocks.
So how are you advising clients to position when you have a lot of these, especially on the labor side, surprising to the upside? You can look at the City Surprise Index, still moving a bit higher there. But then when you look at some other inflation metrics in particular, easing.
Sure, yes. We actually have seen inflation coming down a little bit faster than we anticipated, but we're also watching the core. The core is not coming in quite as quickly, and so we think the Fed got more work to do here, or whether inflation's coming down modestly or not at this point. So that tells us that we need to continue to be defensive in our allocations. And when we say defensive, that doesn't mean all cash. It doesn't mean all short-term fixed income. It means diversifying across fixed income and equities, real assets like commodities, and alternatives if they're appropriate. So that diversified portfolio positioning in terms of recent allocation moves we've made, we have taken some equities, taken some gains out of the equities, moved that into short-term fixed income. And we also like long-term here over 4% on the 10-year.
You mentioned equities. Where specifically were you looking when it comes to industry groups?
Yeah, so in terms of the sectors that we're favoring right now, we do like energy, we like healthcare, we like materials. And I would say that we just recently took some gains out of information technology and moved that to neutral.
Is that just given the huge run over the first half of the year?
It is. Yeah, the technology sector does have very high quality earnings. They're not depending on borrowing at these higher borrowing costs. By and large, the big players in that sector are not. So we like information technology. We just think it's gotten a little bit overpriced. So we moved into cheaper areas of the market, like energy, like materials, healthcare for its defensive positioning.
What about other growth corners of the market if you're thinking about communication services, with obviously houses some big tech names, but then also discretionary?
Yeah, so we think that those sectors are going to perform better as we move through the early part of a cycle. So indicators to us are saying that we're still in the late part of the cycle. I just heard the update on the market where you mentioned that small caps are lagging. They're lagging pretty significantly today. They've been lagging all year. Usually you see small cap companies that are credit dependent, that are services oriented. They tend to do well at the beginning of a cycle, not at the end. And so we're kind of seeing that as indication that we're probably towards the end of this cycle, not the beginning. So those sectors you mentioned, comm services, consumer discretionary, more cyclical, more beginning of a cycle to us.
Hey, Tracy, boy, the 2-year, I can sit in a 2-year bill and get paid more than 5%. Why don't I just do that and then I'm good to go?
Yeah, so we aren't saying that you should not be holding some short-term fixed income. In fact, we did take some out of equities and put it into short-term fixed income, but that's more of a short-term holding. Hold that, earn your 5% right now, and then when we get better opportunities in equities, move it back towards equities. 5% is a great yield. We just don't think it's sustainable in cash. We do think at some point, all the Fed's rate increases are going to have a negative impact on the economy. We'll follow fall into recession and cash rates come back down. So then you've kind of missed out on that opportunity either in longer dated fixed income or in equities.
So then would people potentially also miss out when it comes to money market funds? I mean, that's something that's been a really hot area when it comes to people talking about 5%.
Yeah. Certainly for cash positions, you do want to look for cash alternatives that are unlikely to break the buck, but are still paying those higher rates, 5% plus, very attractive right now.
So, Tracy, really since the great financial crisis, technology sector has really been the sector that's led this market higher. Do you think that still holds for this market, or given where rates are here, we need to look other places?
Yeah. Certainly, the biggest names in the S&P 500 are largely tech names. Those Super 7 stocks that have contributed about 75-80% to the S&P 500 gains so far this year. Note that about 5 of them, as of today's open, were in negative territory for the third quarter. So, since June 30th, they're in negative territory. So taking some gains there is what we see managers doing, what we see investors doing, and we suggest the same. If you're overweight those positions, probably time to take some gains. We'd look to short-term fixed income as an alternative for some of that cash.
And not only do we have a ton of macro on the calendar, but earnings season is about to start. We have JP Morgan kicking things off on July 14th. So at the end of next week, how do you view second quarter earnings season and how it's going to shape up?
Yeah, so we have seen 2 consecutive quarters now of lower earnings. So the earnings recession has begun. We are seeing some revisions to the downside. So, we do think that a recession later this year is probably going to stall growth. So, while at the same time we're seeing margins starting to come in from the high input costs, wage costs are hurting margins as well. So, earnings probably have some room to come down here in the third quarter and fourth quarter estimates, and we see the earnings recession continuing this earnings season.
Okay, so just how much earnings risk do you think is in this market? Again, the S&P is about $220 per share earnings outlook for this year.
Yeah, so far this year, all the return in equities has come from multiple expansion. It hasn't come from earnings growth.
Yep.
The earnings output has actually contracted. Rates down in equity markets right now are pushing prices lower, and I'm sorry, rates up to the 4% level, pushing markets lower now. So, that's a cost that is probably going to start to weigh on earnings as well. So, we see the potential for 205 by year end, to put a number on it. And, that's pretty significant downside from where the estimates are today.
All right, Tracy, thank you so much for joining us. Tracy McMillan, she is head of global asset allocation strategy at Wells Fargo Investment Management. We appreciate getting some of her time. Right now, let's head down to Washington, D.C., world and national news with Nathan Hager.
Paul, the last 3 days have been the hottest on record. That is according to the University of Maine's Climate Reanalyzer. Says yesterday's average global temperature matched a record set Tuesday, which beat a fresh high set the day before. University College London climate scientist Chris Brierley says these new records for global temperatures shouldn't come as a surprise.
They're going to keep rising until we stop emitting carbon dioxide into the atmosphere.
UCL's Chris Brierley. On top of that, Europe's Copernicus Earth Observation Agency says June was the warmest month on record. Ocean temperatures hit new highs last month, and data going back to 1991. Former President Donald Trump's valet has pleaded not guilty to charges he helped hide classified documents from federal authorities at Mar-a-Lago. Walt Nauta is facing 6 counts alongside Special Counsel Jack Smith's 38-count indictment against the former president. Nauta was supposed to have had his arraignment twice before, but he struggled to find a Florida area attorney. Fort Pierce-based Sasha Dodden entered the plea on Nauta's behalf today. Treasury Secretary Janet Yellen's trip to China is underway. She arrived in Beijing this morning. She's got meetings set with the Premier Li Qiang and her former Chinese counterpart Liu He tomorrow. Bloomberg's Enda Curran reports this trip really will be about resetting lines of communication.
The officials on both sides don't know each other, and that's quite a change from where we were, say, in the years before the pandemic and before the hawkish trade policies of the Trump administration.
Bloomberg's Enda Curran says don't expect any major policy changes from this trip. Just in, Georgia Republican Congresswoman Marjorie Taylor Greene has been ejected from the House Freedom Caucus. Maryland Congressman Andy Harris says she was removed from the conservative caucus over her language disparaging another member. She will not be able to attend caucus meetings now. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. Hot data selling a chill through the equity market, with the S&P right now down 44 points, down by 1%. But we begin with the 2-year because the yield there now 5.03%, the 10-year 4.05%. Treasury yields are spiking to levels last seen in 2007. Strong private hiring data is fueling bets that the Fed will have to become more aggressive in its battle against inflation. The Dow now lower by 440 points, and that's off session lows, down 1.3%. S&P at 4403, down 43, a drop there of 1%. Nasdaq down 1%, now down 141 points, and the Russell 2000 is down 2.3%. So it's a down day for the Dow, the S&P, and Nasdaq. Reaction to this morning's economic data from Tracy McMillian, head of global asset allocation strategy at Wells Fargo Bank, who was interviewed moments ago right here on Bloomberg Markets.
The data we got seemed to have spooked investors a little bit this morning with the ADP payroll data coming in stronger, ISM data both coming in stronger than expected. Bonds are selling off, and that's really, to us, confirmation that the Fed has more work to do. Markets seem to be coming to terms with that.
Again, we've got the 10-year at 4.04% now, the 2-year 5.02%. You can hear more of that conversation on the Tapes podcast. You can download it wherever you get your podcasts. Big day for Meta Platforms. Its Instagram unit has officially unveiled Threads, an app that is designed as a direct rival to Twitter, launching the most serious threat yet to Elon Musk's struggling social media site. Meta Platforms shares, they are trading lower by 0.1%. Again, recapping, worth repeating, that 2-year 5.02%, S&P lower by 42, down now by just about 1%, and the Russell 2000 down 2.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Jess Metton and Paul Sweeney here in the Bloomberg Interactive Brokers studio. C-suite conversation today. We're talking hamburgers. How about that?
I'm so excited about this next conversation.
This is going to be fast casual hamburgers. GJ Hart, CEO of Red Robin Gourmet Burgers, joins us. NASDAQ symbol RRGB. You popped that into your Bloomberg terminal.
What a surge this year.
Yeah, you hit the BQ function for a Bloomberg quote, and you see the stock is up 131% year to date. It's got a market cap about $200 million. So we appreciate getting some time from GJ. Give us a sense, GJ, kind of what's driving the performance of your stock this year. Talk to us about your business, because you guys have been in the hamburger business a long time.
Yeah, well, first of all, thanks for having me this morning. It's good to be with you. Yeah, Red Robin, iconic brand, been around over 5 decades, and it's continued to be a family favorite. And what we're doing currently, we have a plan to really bring back hospitality and great food at Red Robin. It's always done a really nice job, but that was really our niche around family fun and great food at a reasonable price. And so what we're doing now is, in the first quarter, we really focused on hospitality. So everything from that guest experience from the time they walk in the door. And I think that has helped propel us with our stock price and everything else that's going on. People have really bought into the plan that we've put in place.
Give us a size and scope of how, when you're thinking about like across the United States, where your businesses are located.
Well, we're all over the United States. Our biggest concentration of restaurants is on the West Coast. We were founded up in the state of Washington, so we do have a big concentration up in the Northwest. And currently, we're pretty much in every market across the United States.
And luckily for me, Jess, I just found out looking at the map that they are down near the Jersey Shore in Brick. Boom, I'll be going to that
near the Sweeney compound.
Yep. Yes, exactly.
We also saw, apparently your favorite Red Robin burger is the Whiskey River Barbecue Burger. I mean, that's something that I would want to try. It sounds pretty amazing. I'm curious, though, especially with your reach around the United States, what is your view of the consumer and consumer spending with what you're seeing with your business?
Yeah, for sure. So from our guests, we're seeing real resiliency. Now, mind you, in our current plan, we call it our comeback plan, and really focused on the things I just mentioned a moment ago. And so we're really seeing a lot of this business drive as a result of us changing within that. And so it's helping our business overall. But net from the consumer in general, they've been really resilient. And at the end of the day, people want to be together. Coming out of COVID, people want to be together and share a meal together. And so it's been great to see. And I hold cautiously optimism that we'll be able to see it going forward.
Have you had to pass on price increases to your customers?
But now we've lagged pricing compared to many of our competitive peers. But of course, inflation is real, whether it's food inflation or labor inflation, everything has gone up. And so we've tried to moderate, and candidly, we've lagged the industry pretty substantially just because we believe it's that important to continue to create value for our guests.
And when you say you were able to lag, I mean, what were you doing to kind of mitigate some of these price pressures?
We just weren't taking the pricing that others were.
So that presumably hit your margins pretty significantly in the most recent terms?
Well, look, at the end of the day, it does hit your margins, but we've had enough other things to drive efficiency, productivity, that it's helped us. So overall, the margins have gotten better for us, but that's a direct reflection of sales.
So talk to us about the labor market. When I walk into a fast casual place, I see a lot of people working behind the counter, a lot of people cleaning up the restaurant, the store. Talk to us, but I know it's hard to get labor these days. How are you guys dealing with that aspect?
Well, I think it starts with having a company that really cares about its people. I know a lot of people say that, but it's really putting your money where your mouth is, and making sure that you have an environment that people want to be in. The labor market has been tough. It has gotten better for sure. And really for us, it's getting the very best people and then training them appropriately. So many times, particularly through COVID, the things that started to drop off were things like training, so someone is set up for success. But net, we feel good about where we are from a labor perspective, and we're continuing to upgrade.
So with what you're seeing on the labor front, do you think that people should be concerned about the trajectory of the economy when you have a lot of this labor data, like we saw earlier today, still coming in pretty strong?
Well, look, I wouldn't consider telling the consumer anything different, but I would say that, again, I'm cautiously optimistic that the consumer will continue to make a choice about dining out, and particularly in casual dining, which is a segment we play in. If you want a great experience with great food and great fun, you come to Red Robin.
Talk to us about the competitive environment out there. Who are your competitors? Is it the McDonald's, the Burger Kings of the world? Is it the Five Guys? How do you segment that market?
Yeah, our primary competition would be other full-service, sit-down restaurants. So the likes of a Chili's, or the likes of an Olive Garden, or the likes of an Applebee's, those type of folks, because it's a sit-down full experience. If you compare the competitive set in just burgers, then you'd bring in some of the fast casual guys like Shake Shack or Five Guys, or folks like that.
We only have about 30 seconds left. What's the top question you hear from shareholders?
What keeps me up at night? Candidly, that's really, I typically answer it like, hey, at the end of the day, making sure we take care of our people and be able to keep them doing what they do well. And secondly, thing I can't control is what's going on around the world. And that definitely keeps me up. But that's generally the question that our shareholders want to hear, as well as the analysts.
All right, GJ, thanks so much for joining us. Really appreciate it. GJ Hart, he's the CEO, Red Robin Gourmet Burgers. The NASDAQ tickers RRGB to pop into your Bloomberg terminal. And I'll be checking one of those out in the not-too-distant future. Again, down on just off Route 70 down in Brick Township.
You're going to get the Whiskey River
barbecue
burger.
Exactly. That sounds pretty good. Again, the stock's having a nice move this year, so good for them. Looking at this market here, kind of coming off the bottom, we're off about 1% on the S&P 500, same about for the NASDAQ. Yields, again, still the story here today. We'll stay on top of that. The 2-year, 5.03%. Did get up to 5.11%. So we'll have to keep an eye on that. This is Bloomberg. get some company news right now with Steve Rappaport.
Paul, U.S. mortgage rates increased for the second straight week, reaching the highest level since November. Freddie Mac says the average for a 30-year fixed loan climbed to 6.81%, up from 6.71%. Freddie Mac's chief economist Sam Cater says high interest rates and low inventory continue to price many potential home buyers out of the market. Mark Zuckerberg didn't take long to use Meta's new platform to call out a tech rival. Zuckerberg in a Threads post writing, "There should be a public conversations app with 1 billion plus people on it." He added Twitter had the opportunity to do this, but hasn't nailed it. More on that from Bloomberg's Ed Ludlow.
That was kind of the most interesting development to me in the last 24 hours. A fun fact that if you consider all of the user base of Meta's other properties, Facebook, Instagram, and WhatsApp, they would only have to onboard 1 in 10 of each of those users to the Threads platform to eclipse what Twitter was able to do with its registered monthly active user base.
Thanks, Ed. Twitter has more than 300 million subscribers. And Uber is seeking to block a New York City rule on a minimum wage for app-based food delivery drivers. The company, in a court filing, asked for a temporary restraining order and a preliminary injunction. Uber argues the minimum wage requirement would cause immediate and irreparable harm in the form of lost goodwill and in the form of non-recoverable costs. Rival food delivery services DoorDash also opposes the rule. That rule is set to take effect this coming Wednesday. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets, followed by Sound On. That's coming up next.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Bloomberg Markets, guess what? It is now on YouTube. Watch every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. Markets coming off the bottom, but still trading lower here. The S&P off just about 0.9%. The S&P up just about the NASDAQ just about the same, and the S&P each off about 1% here, and yields moving decidedly higher. Bitcoin a little bit lower here, still holding above $30,000 per token. WTI crude oil a little bit lower, just above $71 per barrel. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. Scientists generally use long-term measurements, months, years, decades, to track the Earth's warming. But some recent daily highs are an indication climate change is reaching uncharted territory. We get the latest from Bloomberg's Amy Morris.
Earth's average temperature yesterday remained at an unofficial record high set the day before. National Oceanic and Atmospheric Administration Chief Scientist Sarah Kapnick says it's an indication of where we are right now. Scientists have warned for months that 2023 could see record heat as climate change warms the atmosphere. And they noted that La Niña, the natural cooling of the ocean that had acted as a counter, is giving way to El Niño, which means warmer oceans. In Washington, I'm Amy Morris, Bloomberg Radio.
President Biden is taking his Bidenomics pitch to South Carolina today. He's there to tout a $60 million investment in solar equipment maker Enphase Energy. Bloomberg Government's Jack Fitzpatrick with details.
This is sort of a somewhat political follow-up as the president tries to play up some of his legislative achievements, including the CHIPS bill. You'll hear a lot about infrastructure over the next number of months.
Bloomberg Government's Jack Fitzpatrick reports the administration expects the investment in South Carolina to create as many as 1,800 new jobs nationwide. Former President Trump's valet, Walt Nauta, is pleading not guilty to charges that he helped the former president hide classified documents from federal authorities. He was charged with Trump back in June, but his arraignment was postponed twice due to issues finding an attorney, as well as some travel problems. Prosecutors allege Nauta, at the former president's direction, moved boxes of documents bearing classified markings at Trump's Mar-a-Lago resort so they would not be found and returned to the government. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
Thank you, Nancy. We appreciate it. And this story on the terminal,
Yes.
Paul, sharks show up in the Hamptons as summer holiday crowds hit beaches. There's been definitely an uptick here with these sharks.
It's interesting. And Nancy was just having the story about the rising temperatures and ocean temperatures.
Yeah.
Sharks are suspected to have bitten 5 people swimming off Long Island over the extended 4th of July weekend as tourists and locals celebrated the holiday beachside. And this is a growing issue, I think. Maybe it's just an anomaly year to year, but it just seems one of the things I noticed being at the Jersey Shore is really over the last decade plus how clean the waters have gotten, that you can stand, kind of waist deep and still see the ocean floor. So it's gotten cleaner, presumably warmer, and I guess that's good for sea life, including sharks, I guess.
Yeah, and New York reported the most unprovoked shark bites in the U.S. last year after Florida with 8 total attacks. So kind of scary out there, Paul.
Yeah, so we'll have to see. But
again, you're not scared. You're still going to the shore. You're out there every day.
I mean, just getting to the Jersey Shore on the Parkway, that's dangerous enough. I'm not too worried about the sharks. But people, I think it's one of the things that you talk to lifeguards, that's one of the things that they are trained to look out for these days is, stuff, sharks out there, and probably a little bit more than maybe they did a generation ago or so. So, but no, most people I can report from the Jersey Shore of the 4th of July weekend. Everybody was in the water. We just hit 70 degrees, which is kind of the magical temperature for folks in the Northeast to kind of get in the water. So we'll pay attention to that. S&P 500 still trading lower, down about 0.9% on the eco data that we received. Sound On with Joe Matthew. That starts from Washington, D.C. right now.
up BlackRock and others with a flurry of refilings, a possible silver bullet to help get a fund across the finish line.
We'll talk to the CEO of CF Benchmarks about this rush for an ETF. The company is one of the world's leading digital asset index providers.
And a Bloomberg News scoop on bankrupt crypto lender Celsius. CFTC investigators conclude that the firm and its former CEO broke rules before the ultimate implosion.
All right, so all of that is ahead, but first let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And of course, as we've been talking about this rush to a spot ETF, that really has provided a boost for Bitcoin and other digital asset prices, but not so much today. Bitcoin down about 0.5%. We're still north of $30,000, but of course, this is part of a broader sell-off we are seeing in riskier assets. Ether 2 down about 1.3% as we're seeing stocks dragged down by the strong ADP jobs data we got earlier this morning. Feeds into the idea that the Fed's going to have to keep going for a while. The NASDAQ 100, to kind of illustrate that sapped risk sentiment, is down by about 0.9%. One outlier I did want to point to, though, is Bitcoin Cash. This, of course, is kind of a derivative of the OG Bitcoin. It has seen a massive rally over the last several weeks after it was launched on EDX, that new exchange. It had a little bit of selling pressure over the last several days, but up about 8%. We understand South Korean traders may be behind a lot of that, but it is up about 200% year to date. That pretty much dwarfs Bitcoin's 80% year to date gain, though certainly, Matt, that's nothing to